Okay, let's jump straight into this explainer and save your ACCA score from totally avoidable, disastrous mistakes.
Failing by just 2 marks? Honestly, you're probably losing easy points to super basic, careless errors.
We're tackling the top 4 exam traps and their instant fixes right now. Let's hit trap 1.
Double entry bookkeeping. Seriously, stop guessing your debits and credits. The examiners demand a rigid structure.
Your ultimate memory hack? Dead click. Debit, expenses, assets, drawings. Credit, liabilities, income, and capital.
Moving to trap 2, IAS 16. Examiners love catching students dumping revaluation gains straight into the P&L.
The fix? Route those gains to OCI, adjust future depreciation, and totally wipe old depreciation on disposal.
Trap 3. Remember, standard accounting depreciation is strictly disallowed for tax purposes in your exams.
Instead, you've got to apply specific capital allowance rates, AIA at 100%, main, or special pool.
Watch out for the timing trap, though. Tax relief cash flows always lag by exactly 1 year.
Trap 4 is VAT. £90,000 is your compulsory registration trigger for the current syllabus.
Zero-rated supplies let you recover input tax, but exempt supplies absolutely do not. Never mix those up.
For exempt supplies, recovery hinges on a strict de minimis test. Bust those limits, lose your recovery.
But hey, crunching numbers isn't enough. Examiners heavily reward your commercial awareness and practical real-world advice.
Are you really going to let silly traps steal your passing grade? Fix these and pass with confidence.
Go download the complete study notes right now. Don't let easy mistakes tank your exam score.
Welcome to the Explainer. We're diving straight into 7 crucial ACCA APM concepts you'll need for 2026. Think of this as your rapid-fire cheat sheet for modernizing your entire strategic performance toolkit.
First up, let's ask, is your rigid traditional budget actually driving toxic, dysfunctional corporate behavior?
You know, managers often create budgetary slack. They literally pad the numbers just to hit targets easily. This triggers dangerous gaming and short-termism. Imagine slashing vital R&D just to secure a quick bonus. To fix this, truly resilient companies are totally ditching the annual trap for beyond budgeting.
Instead of static budgets, they use adaptive rolling forecasts and dynamic KPIs to stay super agile.
What powers that agility? Big data. It's totally shifting finance from reactive reporting to predictive foresight. Mastering analytics means conquering the 4 V's: massive volume, real-time velocity, crazy variety, and data veracity.
This raw data fuels predictive models, letting you anticipate market risks and sudden demand in real time.
Now, applying those analytics reveals a really harsh truth. Not all your customers are actually profitable.
Customer profitability analysis exposes how hidden service, delivery, and support demands are silently destroying your margins.
Bottom line, true profitability is revenue minus every single specific cost a customer actually generates. To protect those margins, we gotta manage the cost of quality. Prevention is always cheaper than failure. Investing early in training and design totally prevents the devastating costs of external recalls or lawsuits.
For huge initiatives, earned value management is key. It unites your schedule, budget, and actual costs.
Tracking precise cost and schedule variances acts like an early warning system against massive project bleed.
Ultimately, your long-term corporate survival now hinges on a massive 2026 strategic imperative: ESG reporting.
Environmental, social, and governance metrics, they're no longer optional, folks. They directly drive your company's valuation.
It's crazy how electricity completely dominates AI data center costs, making energy efficiency a massive financial liability. By 2026, sustainable finance means deploying AI analytics to provide verifiable, audit-proof green metrics to investors. The APM rules are changing fast, so will your finance strategy evolve or just become obsolete? Hey, ready to master the weighted average cost of capital, or WACC? Let's dive right into this explainer.
Ever look at a client's WACC calculation for fair value reporting and just kinda doubt it?
Yeah, the struggle is real. It's like a frustrating maze of second guessing for so many auditors out there.
Before we hit the traps, here's a super quick refresher on the core building blocks of the WACC formula.
So, today's agenda covers 3 main traps: equity and risk, debt and tax, and structural flaws.
All right, let's kick things off with trap number 1, equity and risk errors.
Error 1 is wrong risk-free rates. FRS 36 says consider the time value of money over the asset's useful life. Error 2 is inconsistent beta. You absolutely need exact industry or public company data, not just some unrelated numbers. Next up, error 3. It's totally crucial to use the country of actual operation, not just where it's registered.
And error 7, overlooking the country risk premium. This literally understates equity costs and massively overstates value.
Okay, moving right along to trap number 2, debt and tax mistakes.
Error 4 is misjudging debt costs. WACC needs a rate that actually reflects business risk, not just credit risk.
For error 6, don't neglect tax effects. Make sure you use the marginal corporate rate, not VAT or withholding.
Finally, let's look at trap number 3, structural flaws. These can really mess up your whole framework.
Error 5 is huge. Regulators demand market values for capital structure weights, so definitely stop relying on book values. By dodging these errors, you can confidently advise clients and literally double your impact in half the time.
So, for bulletproof valuations, just run through this final checklist from the WACFinder Blueprint. It's a total game changer. So, are you ready to elevate your fair value reporting and lock in that lasting stakeholder trust?
Okay, let's dive into this. Welcome to our latest explainer. Today we are unpacking one of the absolutely defining moments of modern economic history, the global financial crisis of 2008. Now we're going to do something a little different and honestly, really effective with this explainer. We aren't just going to decode the timeline and the mechanics of the crash. We are actually going to practice the exact authoritative English vocabulary used in Wall Street boardrooms and at the Capitol. We're going to use a linguistic technique called shadowing to build your professional fluency right alongside the narrative. It's going to be a fascinating ride, so let's get right into it. To really grasp the sheer gravity of what went down, you just have to look at the words of Ben Bernanke, who was the chairman of the Federal Reserve at the time. He was speaking to a room full of absolutely shocked congressional leaders late on a Thursday afternoon, and he delivered a warning so stark the oxygen literally left the room. We were days, maybe even just hours, away from a total global economic collapse. Now, before we explore exactly how we got to that terrifying brink, let me briefly explain how our English shadowing practice will work. In just a moment, when we get to a shadowing phrase, I'll speak a key financial term slowly and clearly. Then I want you to repeat that phrase out loud exactly like an echo. We'll do it twice for each phrase to really help you build that rhythm, intonation, and confidence. But before we get into analyzing those high-level boardroom decisions, we actually have to start right here on Main Street. 9 million? It's a staggering number, right? This figure represents the visceral human tragedy of the crisis. 9 million families were evicted from their homes. People who believed the American dream of homeownership was finally within reach found themselves completely financially ruined. To truly wrap our heads around this financial crisis, our story has to stay grounded in this reality. This is the human face of a massive, complex failure of the system. Which brings us right to our first shadowing practice, focusing on the exact catalyst for those 9 million evictions. Listen closely to my pronunciation and repeat it out loud with me in a clear, authoritative cadence. Ready? The bursting of the housing bubble. Now let's do that one more time. Speak with total confidence. The bursting of the housing bubble. Excellent. That single phrase is the starting point for absolutely everything that follows.
So, what caused that bubble to inflate so massively in the first place? Well, it really comes down to mortgage-backed securities. For years leading up to 2008, the road to absolute riches for massive investment banks, places like Bear Stearns and Lehman Brothers, was terrifyingly simple. They bought up hundreds of thousands of home mortgages, particularly subprime mortgages, which were given to borrowers with pretty poor credit. Then they bundled them all together into these complex, supposedly completely safe securities and sold them off to investors all over the globe. The working theory was that by pooling them all together, the risk was diluted. But in reality, lenders were handing out adjustable rate mortgages with zero credit checks to people who simply couldn't afford them.
Behind the scenes, it was a shockingly simple game. Jeffrey Lane, a CEO at Bear Stearns Asset Management, hit the nail on the head when he described it. These highly leveraged, totally toxic assets were just being passed around the global financial system. Everyone was making massive fees. Wall Street was basically having a giant party, playing an incredibly high-stakes game of hot potato. But you know how the game works. When the housing market finally turned and those subprime borrowers couldn't pay their mortgages, the music stopped. The toxic assets suddenly couldn't be sold. And as Lane said, everyone ended up holding a potato. The entire global system suddenly found itself holding on to unimaginable toxic risk.
Let's elevate our analysis for a second to the CFO level using this dual iterative framework. We really need to bridge the emotional, human story with the dense institutional jargon that policymakers use. So when we talk about risky mortgages for families, a central banker is going to call that high-leverage toxic assets. When regular people start panicking and pulling their credit, Wall Street calls it a liquidity contagion and freeze. Mastering business English in the world of finance means you have to understand both of these columns. You need the narrative to actually understand the context, but you absolutely need the institutional vocabulary for authority and precision. Let's master the authoritative phrasing for this exact scenario right now. This is a highly technical, absolutely vital phrase. Listen to the stress on the words and repeat after me. Liquidity contagion and freeze. Great, let's lock it in one more time. Liquidity contagion and freeze. When banks stop trusting each other, when they look around and refuse to lend money, commerce literally just grinds to a halt. That, my friends, is a liquidity freeze.
Now, what's really interesting here is the ultimate nightmare scenario for a central banker: systematic risk. Now, unsystematic risk, say a specific company having a really bad quarter or a warehouse catching on fire, that can be handled just by diversifying your portfolio. But systematic risk? That threatens the foundation of the whole shebang. By March 2008, regulators woke up to the fact that investment banks like Bear Stearns were frighteningly interconnected with every other bank up and down Wall Street. If one single bank failed, they all could fail. It was this exact fear of systematic risk that led a panicked Tim Geithner to make a 4 a.m. emergency phone call to Ben Bernanke, setting off the very first government interventions.
And a massive contributor to all this systematic risk was something operating entirely out of the light. Listen carefully to the terminology here and repeat it with me: the shadow banking system. Once again, nice and clear, the shadow banking system. Over a couple of decades leading right up to the crisis, a sprawling, completely unregulated shadow banking sector had grown so large that it looked basically identical to the traditional banking system. Investment banks were acting exactly like commercial banks, but with none of the safety nets. So when the panic hit, neither system could bail the other out. They had identical exposures. They literally had nowhere to turn but to the policymakers in Washington.
So the absolutely crucial question is, why didn't the government just immediately step in and save everyone? Well, because of moral hazard. This was the agonizing dilemma that Treasury Secretary Henry Paulson faced. Think about it. If the government uses taxpayer money to rescue Wall Street billionaires from their own reckless gambling, doesn't that just guarantee they'll do it again? Paulson faced immense political pressure from both sides of the aisle. Critics understandably demanded to know why hardworking cab drivers, folks working overtime just to pay their honest mortgages, should watch their tax dollars go to rescue irresponsible wealthy bankers.
The contagion built at terrifying speed. You can see it on the timeline. In March, the Fed helps JP Morgan rescue Bear Stearns. Over the summer, the contagion just keeps spreading. And by early September, Paulson has to nationalize Fannie Mae and Freddie Mac, two absolute pillars of the mortgage industry. But then comes mid-September. Lehman Brothers. Paulson, who is suffering from serious bailout exhaustion and deeply fearing this moral hazard we just talked about, draws a line in the sand. He lets Lehman go bankrupt, firmly believing the broader market can handle it. Well, he was wrong. The collapse of Lehman proved the system was far, far more interconnected than anyone knew. The global markets instantly crashed. Moral hazard temporarily trumped systemic risk, and it nearly destroyed the global economy. Paulson immediately realized he had to change course.
That sudden realization led directly to our final vocabulary focus. Let's shadow this phrase together, really making sure to reflect the sheer gravity of this multi-billion-dollar decision: nationalization and Wall Street bailouts. One last time, really own the phrasing: nationalization and Wall Street bailouts. With the credit markets entirely frozen solid, Paulson and Bernanke just abandoned their case-by-case approach. They marched into Congress, delivering that chilling quote we explored at the very beginning, and requested $700 billion. It was an act of economic shock and awe, meant to buy up all those toxic assets and literally unstop the global financial system.
And that brings us to the aftermath, and a really lingering question to end our explainer on today. While the bleeding was technically stopped and the global economy slowly, painfully recovered, the legacy of 2008 is incredibly complex. The massive financial institutions paid their massive fines, sure, but the individual architects of those toxic assets, they largely didn't suffer any personal consequences. Meanwhile, millions on Main Street lost an entire decade of wealth. So looking around at the complex, highly leveraged financial products that are still circulating out there today, we have to ask ourselves, have the underlying systemic risks of 2008 truly been resolved? Or did we, as a global financial system, just bury the hot potato deeper? I'll leave you to ponder that one.
Thanks for joining me for this explainer, and definitely keep practicing that vocabulary. Never use weak words like check or verify in your AA exam.
Examiners give 0 marks for generic procedures.
Now, what's really interesting about this slide is seeing those 0-mark words versus full-mark active verbs.
You gotta use inspect when you're examining tangible assets or documents. Think of a title deed.
Watching a process happen, like a live inventory count, observe is literally your go-to verb here.
So, the crucial point is, use confirm when getting a direct written response from a third party. Checking mathematical accuracy, like depreciation, the exact action verb you absolutely need is recalculate.
And this brilliantly illustrates how reperform scores marks when you're executing a control again, like bank recs.
Nailing this specific vocab gives the exact evidence examiners demand. It's how you pass the paper.
So always use active verbs like inspect, recalculate, or confirm. Download my paid AA notes.
Welcome back to The Explainer. Today, we're basically putting on our detective hats to demystify ACCA Advanced Audit and Assurance Batch 3 topics. We are moving way, way beyond basic auditing today. We're stepping into those complex, high-risk scenarios where your professional skepticism isn't just a nice-to-have skill, it's literally your most critical tool. If you want to pass this exam, you've got to think like an audit partner, and that's exactly what we're going to practice right now. We've got a packed lineup for our investigation today. We're hitting value for money, estimates and fair value, auditing related parties, handling subsequent events, and finally, going concern assessments. Let's jump right in. Section 1, value for money, or VFM. Our first stop shifts our focus over to the public sector. Unlike corporate audits, where we're mostly obsessing over profit margins and financial statements, here we're investigating performance. Specifically, how well do government programs actually utilize their funding? As an auditor in this space, you really aren't just checking the math. You're evaluating what we call the 3 E's. First step, economy. Are they minimizing their input costs? Think about the cost per unit. Second, efficiency. Are they squeezing the maximum possible output out of every single pound spent? And finally, effectiveness. Are they actually hitting their stated targets? You'll be evaluating all of this using KPIs and benchmarks. So, if you take away just one thing to cement in your memory for public sector scenarios, make it this. VFM equals economy, efficiency, and effectiveness. Oh, and remember, you're likely going to be providing negative assurance here, basically stating that nothing has come to your attention to suggest these 3 E's aren't being met. All right, moving on to Section 2, estimates and fair value. These 2 areas are going to seriously build out our detective toolkit as we tackle ISA 540 and IFRS 13. Why? Because they are heavily prone to management bias. They require high judgment valuations, not just simple, hard facts. Listen, your internal threat radar should be absolutely blaring right now. Management bias is a massive risk. You've got to independently challenge their assumptions. Are they using consistently over-optimistic growth rates just to inflate their asset values? Have they suddenly made unprompted, completely unjustified changes to their methodology just to hit a bonus target? You cannot just accept their word for it. You have to investigate. Now, IFRS 13 handles fair value through a really strict hierarchy of evidence. We drop from level 1, which is the gold standard, highly reliable quoted prices in an active market, like stock exchange prices, down to level 2, which relies on observable inputs, like standard interest rates. But the real danger zone, that's level 3. That relies entirely on highly risky, unobservable internal data generated by the entity itself. Because level 3 is essentially management doing their own math behind closed doors, we must aggressively investigate. You can't just tick a box here. You have to evaluate the appropriateness of their valuation models. You need to run sensitivity analysis. What happens if their assumptions are even just a little bit off? And most importantly, because these inputs are so complex and unobservable, you almost always need to bring in your own independent valuation specialist. So, lock this one-line cheat code into your mind before the exam. Whenever estimates, provisions, or unobservable fair values pop up in a scenario, your response should be automatic. You test their assumptions, you hunt ruthlessly for management bias, and you call in the external experts. Okay, Section 3, auditing related parties. Let's crack open the case file on ISA 550. The primary risk here isn't a simple calculation error. It's hidden, non-arm's length transactions taking place between connected entities, like a parent company and a subsidiary, or maybe a director and the business. So,
how exactly do we uncover these relationships if management is deliberately trying to sweep them under the rug? We can't just trust the general ledger or the initial list management hands over. We've got to dig so much deeper to ensure completeness. You must actively investigate, read through the board minutes, cross-reference the contracts, and scrutinize the share registers to spot any of those hidden connections. Once you actually find a related party transaction, you have to test it against the open market to see if it was legitimately priced at arm's length. And finally, you absolutely must get management on the record with written representations confirming they've disclosed all related parties to you. Make sure you remember this punchline. The hunt is always twofold. First, you're searching for hidden connections to ensure completeness, and second, you're looking for shady sweetheart deals that don't match up with market prices. Oh, and if there's no documentation for a transaction, you need to start considering the risk of fraud. Moving into Section 4, handling subsequent events. We are now entering the completion phase of the audit with ISA 560. Here, we're basically acting as time-traveling detectives to figure out exactly how to handle massive events. Think a warehouse fire or a major customer going bankrupt that happen after the year-end date but before the financial statements are published. The timeline here is critical to understand. From the year-end date right up until the exact moment you sign that audit report, you had an active duty to hunt for new evidence. You've got to read post-year-end minutes, review management accounts, and ask about new litigation. After you sign the report, that active duty ends. But if you happen to stumble upon something before the statements are officially issued, you still have to discuss it with management. Understanding these two concepts solves the ultimate exam trap. How do you actually treat the event? It's pretty simple once it clicks. If the root condition existed before midnight on the year-end date, say a customer who was already struggling finally goes bankrupt in January, you go back and actually adjust the numbers in the financial statements. But if it was a brand new disaster that arose after year-end, like a factory burning down in February, you do not change the numbers. You only disclose the event in the notes. Commit this single sentence to memory so you never stumble on the adjusting versus non-adjusting rules again. You have an active duty until the audit report, and you only adjust for what already existed. For the brand new stuff, you just disclose. All right, final stretch. Section 5, Going Concern Assessments. Under ISA 570, we are dealing with the ultimate corporate nightmare, a company teetering on the brink of collapse. Assessing going concern is easily one of the most high-stakes judgments you will make as an auditor. The standard is super strict on this timeline. We are looking at survival for at least 12 months from the reporting date. If you spot red flags of distress, things like loan defaults, bleeding cash flow, or the sudden loss of a major supplier, you cannot just nod along with management's rosy survival plan. You must rigorously challenge their cash flow forecast, test their assumptions, and figure out if their refinancing plans are actually living in reality. Think of this as your ultimate cheat sheet for formulating the audit report. If the company is facing a material uncertainty, but management has been totally transparent and adequately disclosed it in the notes, you give an unmodified opinion, but add an emphasis of matter paragraph to point the user directly to that note. However, if management tries to hide the crisis with inadequate disclosure, you've got to hit them with a qualified or an adverse opinion. And if there are multiple, massive uncertainties everywhere, you just issue a disclaimer of opinion. This one-liner perfectly resolves the whole going concern mystery. It gives you the exact reporting flow for applying the standards to a struggling client. Seriously, write this down because knowing this cold is practically guaranteed to save you marks on exam day. As we wrap up today's explainer, I really want to emphasize the overarching theme of advanced audit and assurance. To pass this exam, you can't just be an accountant who simply adds up columns of numbers. You must act as an investigator. You've got to actively question the evidence, push back on management bias regarding estimates, hunt down those hidden related parties, and make the tough calls on whether a company is actually going to survive. That mindset shift, that's exactly what takes you from a passing grade to an excellent one. So the next time you sit down with an exam scenario, ask yourself, are you just going to blindly read the numbers, or are you actually going to interrogate them? Keep that professional skepticism sharp, guys. Happy investigating.
Okay, picture this. You're about to sign your name to a piece of paper. But this isn't just any piece of paper. It's a document that literally dictates the financial fate of a billion-dollar company. Pretty heavy, right? Well, welcome to this explainer. Today, we are unpacking the incredibly high-stakes world of the auditor's report and governance communications. We're going to break down exactly how an auditor officially communicates their findings, starting from the most public-facing documents and pulling back the curtain all the way to the private boardroom. Let's dive in.
So, here's our game plan. We're going to cover the core opinion, key audit matters, emphasis versus other matters, other information, and wrap up with communicating with governance and the management letter.
Kicking things off on the public stage, we have Section 1, the auditor's core opinion.
Now, when an audit actually reveals a problem, the auditor has to modify their opinion based on two absolutely crucial factors: the exact nature of the issue and just how widespread it is. Think of this little 2x2 matrix as your ultimate diagnostic toolkit. If you find a material misstatement but it's contained to just one specific area, you issue a qualified or except for opinion. But if that misstatement is material and highly widespread, it escalates to an adverse opinion. On the flip side, what if you simply lack the evidence to make a call at all? Well, it's qualified if it's contained, but it becomes a full-blown disclaimer of opinion if the missing evidence is massive and widespread.
Now, you might be wondering, what's the catch? The absolute linchpin of this entire framework is the word pervasive. In our world, a pervasive issue isn't just some localized inventory glitch. Oh no, it means the issue bleeds across multiple critical areas. We're talking revenue, receivables, and cash, all at once. It's a flaw so vast that it fundamentally alters how someone understands the financial statements as a whole. And honestly, missing a pervasive issue, that's exactly how those massive corporate collapses catch investors completely off guard.
So here is your ultimate one-line summary to lock in for the exam. Material but contained equals a qualified opinion. Material and pervasive equals an adverse opinion. And if you have absolutely zero evidence for a massive structural issue, you've got to issue a total disclaimer. It is a very rigid, non-negotiable hierarchy of financial warnings.
Moving right along to Section 2, Key Audit Matters, governed by ISA 701.
For listed companies, you are required to include a KM section in your report. You can think of this as a highlight reel of the absolute biggest risks the auditor faced during the engagement. To craft a solid KM, you have to describe the matter and explicitly state exactly why it was significant. Then, you lay out how the audit team tackled it, listing specific procedures and findings, and finally, you point the reader directly to the related disclosures in the financial statements.
Okay, listen up, because this is a massive exam trap. A key audit matter is never a substitute for a modified opinion. You can't just take a massive, glaring misstatement and quietly bury it in your highlight reel. Actually, scratch that. It goes even further. If you issue a disclaimer of opinion because you lack evidence, you cannot include a KM section at all. I mean, it makes sense, right? How can you highlight significant audit matters when you couldn't even get enough evidence to form a baseline opinion? No way.
Next, we add another layer to our public reporting with Section 3, Emphasis and Other Matters.
You need to know there is a distinct, hard line between an emphasis of matter and an other matter. You use an emphasis of matter, or EOM, to spotlight a crucial issue that management has already properly disclosed in their notes. It's like a company fighting an existential lawsuit that could literally bankrupt them. The EOM doesn't modify your opinion, it just points a giant neon sign at that specific note. On the other hand, an other matter, or OM paragraph, provides vital context that isn't in the financial statements anywhere. A classic example, pointing out that the prior year's financials were audited by a completely different firm.
So it really just boils down to this elegant distinction. EOM spotlights a disclosed matter, while OM provides outside context. Lock this golden rule into your memory, because examiners love to test your understanding of this boundary.
All right, widening our net a bit, let's look at Section 4, Reviewing Other Information.
You know, the auditor's job doesn't end when the spreadsheets close. They actually have a duty under ISA 720 to read the other information in the annual report, like that glowing management commentary right at the front. Why? To play detective. You're hunting for material inconsistencies. Let's say the CEO's opening letter proudly boasts that revenue doubled this year, but your audited financials show it shrank by half. Yeah, you've got a massive problem. You have to request a correction. If management refuses to fix it, you have to consider modifying your report, potentially calling them out with an other matter paragraph.
So far, everything we've talked about has been on the public stage. But as we transition to our final act, we really have to ask ourselves, what kind of private conversations are happening in the boardroom before that report ever sees the light of day?
Leaving the public eye, we enter Section 5, Communicating with Governance.
When you're sitting across from the board of directors or the audit committee,
timely communication is absolutely paramount. This is your checklist. The auditor has to clearly lay out their responsibilities, flag any potential threats to their independence, and give the board a heads up on significant planned risks. You're also required to present your going concern assessments and point out any weird related party transactions way before that final report gets drafted.
Ultimately, the core philosophy of ISA 260 is simple: no surprises. It's all about ensuring the highest level of leadership is never caught off guard. Transparency happens in this room first, so the board can fix systemic issues before they blow up into very public scandals.
And finally, for our last act, we reach Section 6, the management letter. Under ISA 265, when you report internal control issues to management, it has to be highly structured. You must clearly describe the specific deficiency, explain the potential ripple effect it could have on the business, offer a concrete recommendation to fix it, and, this is key, capture management's official response to your findings.
But watch out for another huge exam trap here, folks. The management letter is exclusively for significant deficiencies. You don't use it to complain about every minor administrative typo, and more importantly, this is a private document. It never, ever excuses a material misstatement in the public report. If a broken control led to a massive financial error, you absolutely still have to modify the public audit opinion. Seriously, an auditor can never use a private letter to cover up a public disaster. It's a fundamental, non-negotiable rule of the profession. Keep this front and center in your mind. By mastering this layered reveal, starting from the very public audit opinion and working our way down to those intense, private boardroom conversations, you finally understand the true weight of the auditor's pen. So here's a thought to leave you with. The next time you flip through a polished annual report, ask yourself, what private boardroom battles were fought before that one, clean, true and fair opinion was finally signed? Thanks for joining me on this explainer, and I'll catch you in the next one.
Welcome to the Explainer. Today, we're transitioning out of the world of basic auditing principles and stepping way up. We're talking about the advanced professional judgment required at the absolute highest levels of practice. We are getting into complex corporate audits, where the stakes are massive, the rules are incredibly strict, and the margin for error is basically zero. So if your goal is to really start thinking like an audit partner, well, you're in exactly the right place.
Here is our roadmap for today. We're doing a macro to micro to macro journey. We'll start with firm quality under ISQM 1, then engagement reviews under ISQM 2, touch on advanced ethics, professional skepticism, and wrap it all up with group audits under ISA 600.
Section 1. Firm quality, specifically ISQM 1. Let's dive right into this macro level.
Now, if you take away just one word here, make it proactively. In advanced auditing, you really can't afford to just react to problems when they pop up. ISQM 1 dictates that a firm must have a proactive, living system that is literally designed to stop bad audits and, massive corporate collapses before they even have a chance to begin. It also requires annual monitoring and remediation just to make sure you're constantly fixing any cracks in the foundation. This firm-wide quality system is actually built on 8 core components. Think of it like a giant interconnected web. It covers everything from governance and leadership at the very top, down to how resources are allocated, your risk assessment process, relevant ethical requirements, and how client engagements are accepted in the first place. It guides engagement performance, information and communication, and of course, that continuous monitoring and remediation. It's essentially your ultimate safety net.
All right, Section 2, Engagement Reviews, ISQM 2.
It helps to think about it this way. While ISQM 1 acts as an umbrella for the entire firm, ISQM 2 pulls out a magnifying glass. It mandates a specific engagement-level quality review, and this is absolutely critical when you're dealing with listed entities or particularly high-risk audits. This means bringing in an engagement quality reviewer, or EQR, and they need to be a completely independent, highly experienced second pair of eyes. Because of how critical this role is, they absolutely cannot be part of the core engagement team. They can't be subject to any independence threats, and they must have the sheer authority to challenge the audit's most critical decisions. We're talking materiality, fraud discussions, and going concern assessments.
Section 3. Advanced Ethics and Threats. This is where we pivot to the micro level. We all know the basic ethical threats, right? self-interest, self-review, advocacy, familiarity, and intimidation. But here's what's fascinating. When you look at the AAA context, these basic threats upgrade into severe professional dilemmas. For example, an advocacy threat isn't just about casually hyping up a client, it's about being pressured to practically act as their lawyer. Or familiarity? It's not just knowing the client well, it's a 10-plus year association that completely blurs your professional boundaries. And because these threats are so severe, the rules around providing non-audit services become incredibly strict. Sure, some basic tax compliance might be permitted if you have the right safeguards in place, but for listed clients, there are absolute prohibitions. You literally cannot provide bookkeeping, material valuation services, or outsourced internal audits for them. Doing so creates a fatal self-review threat that simply cannot be safeguarded against. No way.
And to further protect that independence, you need to remember this crucial number: 5. For key audit partners working on listed clients, there is a strict 5 years on, 5 years off cooling off period. You rotate off the engagement, period. That ensures a fresh, unbiased perspective is always maintained.
Section 4. Mastering professional skepticism. Still at the micro level here.
Professional skepticism is the ultimate behavioral tool you must possess. It's a required forensic mindset. Question, corroborate, verify. You simply cannot just take management at their word. And look, it's not about being needlessly cynical, but it absolutely means you do not assume management is inherently honest. So what does this actually look like in the real world? It's an active 3-step process. First up, you have to challenge management's assumptions, especially when they hand you really optimistic forecasts or valuations. Second, corroborate their explanations with external, entirely independent evidence. And third, verify the actual physical existence of assets. Don't just stare at a piece of paper for $1 million machine. Go down to the factory floor and actually point at it.
And finally, Section 5. Group audits under ISA 600. We're zooming back out to the macro level.
When you're auditing a massive corporate group, there is a clear division of labor, but definitely not a division of accountability. The group auditor takes full 100% responsibility for the final group opinion. They can't just pass the buck and blame a component auditor in their report. The component auditor, meanwhile, executes the audit of a specific subsidiary, but they do it based entirely on strict instructions handed down by the group auditor.
To keep a complex global audit from just completely spiraling out of control, the group auditor has to act like an absolute commander. They mandate specific items down the chain. They dictate the group's accounting policies, enforce strict independence and reporting requirements, and flag related party transactions, as well as any identified significant risks.
And here's a massive point. The group auditor dictates the materiality for the component, and it must be set lower than the overall group materiality. Why? Aggregation risk. If every single subsidiary had errors just sitting right under the group materiality threshold, those are going to aggregate right up at the group level and cause a massive, unacceptable misstatement. Now let's pose a really high-stakes scenario. Imagine you're the group auditor. You are carrying all of this responsibility. What do you do if management suddenly blocks you or your component auditor from seeing the books of a highly material subsidiary?
The answer is punchy, and it's severe. If you are restricted from access, you cannot obtain sufficient appropriate audit evidence. And if that component is material, well, you have absolutely no choice but to modify the group audit opinion. That means you're issuing either a qualified opinion or a full disclaimer of opinion. And make no mistake, that has severe real-world impacts for the client's market standing and their regulatory compliance.
So we've gone from the macro governance of an entire firm all the way down to individual ethics and skepticism and back out to the massive accountability of group audits. The real question is, are you ready to apply this advanced mindset and truly think like an audit partner? Thanks so much for joining me for this explainer, and I will catch you next time.
Hey everyone, welcome to The Explainer. Today, we are completely shifting gears and decoding the source material on advanced audit investigations. We're leaving the standard, routine external audit in the rearview mirror and stepping straight into the high-stakes world of advanced assurance. Now, this isn't about your basic box ticking or just making sure the numbers add up. Oh no, advanced assurance requires a totally elite investigative mindset. So, you know that standard audits are all about looking for material misstatements to give reasonable assurance to shareholders, right? But what happens when you need to actively hunt down deliberate fraud? For this, I really want you to step into the role of a financial detective. Your job is no longer just to review things. Your job is to uncover exactly what other people are desperately trying to hide.
Let's crack open case 1, the fraud. We're talking about the forensic audit. This is where accounting literally meets the courtroom in a high-stakes hunt for financial misconduct. And there's a really stark contrast here. In a typical external audit, you rely on sample-based testing to give reasonable assurance, you report to the shareholders, and you generally assume management is neutral. Well, a forensic audit flips that entirely on its head. It's highly investigative, specifically designed to gather evidence for a court of law or for lawyers. We don't just sample, we do 100% testing on the affected areas. And honestly, the biggest psychological shift is this: we assume fraud actively exists. To pull this off, you need a seriously different toolkit. The forensic auditor's toolset looks a lot like a true criminal investigation. We rely heavily on data analytics, using mathematical principles, like Benford's law, to spot unnatural anomalies in massive data sets. We use computer forensics to recover files that someone thought they permanently deleted. We meticulously examine physical and digital documents for forgery or subtle alterations. And, crucially, we use advanced interrogation and interview techniques to extract the truth from people who might be actively lying to us. So, if you need one quick summary to lock into your memory for your exams, forensic audit equals investigating fraud for court using 100% testing, data analytics, and interviews. All right, let's move to case 2, the criminal. This is all about money laundering and the Proceeds of Crime Act. Here, we step into a realm where you act as a vital shield, literally preventing organized crime from infecting the legitimate economy. First, we've got to define the enemy. Money laundering is the act of concealing the proceeds of criminal activity to make them appear completely legitimate. It's all about taking dirty money and trying to make it look clean. Criminals usually follow a pretty specific 3-step playbook to wash this illicit cash. Step 1 is placement, and this is actually the riskiest phase for the criminal, where they physically introduce illegal cash into the financial system. Step 2 is layering. They use these dizzying, complex webs of wire transfers and transactions to totally obscure the original source of the money. And finally, Step 3 is integration. The funds are returned to the regular economy, maybe through buying real estate or luxury assets, so they appear completely legitimate. Because this threat is so severe, your legal duties here are incredibly strict. You have to perform robust KYC, know your client procedures. And that means figuring out not just the corporate shell, but the ultimate beneficial ownership, like who is actually pulling the strings. If you spot something that just doesn't add up, you are required by law to file a SAR, a suspicious activity report, usually to your firm's nominated officer or directly to the National Crime Agency. And pay close attention to this. Failure to report those suspicions is actually a crime for auditors. You carry personal criminal liability if you just look the other way. But listen, there is a massive trap here, and examiners absolutely love to test this. Tipping off is a criminal offense. If you file a suspicious activity report, you absolutely cannot let the client know they're under suspicion. Doing so could alert them to destroy evidence or flee, and it will land you in some severe legal trouble. Let's cement this second case file with a powerful memory hook. Money laundering equals concealing criminal proceeds. The auditor must report suspicious activity, and remember, absolutely no tipping off. Okay, let's pivot for a second to something that feels a bit like a paradox. Think about this. How exactly do you audit something that hasn't even happened yet? Well, that brings us right to case 3, the future. Prospective financial information, governed by ISAE 3400. We're opening the file on how financial sleuths analyze forward-looking data. And there's a really specific nuance you need to grasp here. Forward-looking info basically comes in 2 flavors. A forecast is based on expected future events and management's absolute best estimate of what is going to happen. A projection, on the other hand, is based on hypothetical assumptions. It's a what-if scenario. Knowing the difference between those two is absolutely vital when assessing management's plans. So what exact procedures do we use to test these future predictions? I mean, we don't have a crystal ball, so we have to test the mechanics. We evaluate if management's assumptions are actually reasonable and if they align with historical performance. We rigorously test the mathematical accuracy of their calculations. We assess if the numbers are consistent with the company's overall business plan. And crucially, we must obtain written representations from management confirming their responsibility for these assumptions. Because the future is, inherently uncertain, we cannot offer the positive, reasonable assurance of a standard audit. Instead, PFI engagements only offer limited assurance. We use cautionary, negative language in a report, basically saying,
Nothing has come to our attention that causes us to believe the assumptions do not provide a reasonable basis for the projection. Plus, we have to explicitly state that actual results are likely to be different. To summarize this future-focused investigation, keep this one-liner in mind. ISA 3400 gives limited assurance on forecasts. Your job is to test assumptions and the math, and always include cautionary language. And that brings us to our final file, Case 4, The Secret, Due Diligence. This is where you dig deep into a target company's closet right before a major deal goes down. Due diligence is a comprehensive investigation of a target company before a merger, acquisition, or significant investment. It is so essential to understand that this is an agreed-upon procedures engagement. We aren't giving a traditional audit opinion here. We are providing factual findings based on a very specific scope of investigation, all to help the buyer make a truly informed decision. Uncovering those hidden corporate secrets requires a massive, multidisciplinary scope. It's really not just about the numbers. Sure, financial due diligence looks at historical performance, assets, and hidden liabilities. But we also look at tax to find compliance exposures. We review legal, digging into contracts and any ongoing litigation. We assess operational realities, things like IT systems and supply chains. We even look at environmental factors, hunting for contingent liabilities like unrecorded pollution cleanup costs. As the financial sleuth here, you're constantly on the lookout for major red flags to protect the acquiring company from buying a total disaster. You're going to calculate normalized earnings by stripping out sneaky one-off gains management might have included just to inflate the price. You identified the true, ongoing working capital requirements. You hunt vigorously for off-balance sheet liabilities that standard audits might totally miss. And you expose related party transactions that just don't reflect true market reality. Let's lock in our final exam trigger for this case file. Due diligence equals investigating a target before an acquisition, and it spans financial, tax, legal, and operational boundaries. All right, time for the auditor's verdict. Let's wrap up these case files. We have covered some serious ground today, bringing 4 incredibly powerful investigative disciplines together. Whether you are performing 100% testing in a forensic fraud hunt, shielding the economy from money laundering through strict SAR reporting, testing the mathematical assumptions of the future under ISA 3400, or tearing through a target company's secrets in due diligence, mastering these 4 areas transforms you from a standard accountant into a high-level business protector. You've now got the mindset of a financial sleuth. The only question left is, are you ready to catch what everyone else misses? Keep this structured approach in mind, apply it to your studies, and you'll be absolutely unstoppable.
Listen to me closely. If your ACCA exam is literally days away and you're feeling totally overwhelmed, just stop right now. Take a deep breath. You are in exactly the right place. Welcome to this Masterclass Explainer. I'm here to execute a rapid-fire, completely no-fluff rescue mission to get your brain locked in and exam ready. We're cutting out all the noise, dropping the textbook filler, and focusing exclusively on the high-yield, pure signal concepts that are going to drag you across that pass mark. So I need your absolute, undivided focus for the next few minutes. Let's get into it.
I want this to burn into your memory right now. You will learn more from your mistakes than from any notes. Listen, this isn't just some cheesy motivational poster. This is your absolute battle cry for these final hours. Stop passively reading endless pages of text. The ACCA examiner is not going to test your ability to highlight a textbook. No way. They are testing your ability to navigate their traps. And honestly, the absolute fastest way to learn how to dodge those traps? Fall into them right now, figure out exactly why you fell, and make sure you never, ever do it again. So here's our 3-step game plan to get you exam ready. Number 1, ultra-fast revision. Number 2, common exam mistakes and fixes. And number 3, practice strategy. Let's kick things off with Section 1, ultra-fast revision. All right, shift your brain into top gear right now. No more long paragraphs. We are hardwiring one-line triggers into your mind so they fire off automatically. Boom. Adjusted present value. If you're sitting advanced financial management, this is an absolute must-know. APV literally separates the operating NPV from the financing side effects. You need to instantly generate this formula in your head. Base case NPV plus the present value of the tax shield on debt minus your issue costs plus the present value of any subsidized loan benefits. Drill that exact sequence. Base plus tax shield minus issue plus subsidy. Lock it in. Okay, let's see how fast we can trigger your recall across different papers. Ungearing beta, you're removing financial risk using 1 minus the tax rate.
Target costing? It is always the target selling price minus your desired profit, and you absolutely must close that gap with value engineering. Throughput, it's simply your sales revenue minus direct material cost only, and your entire goal is to maximize it per bottleneck hour. Lock these associations into your brain immediately.
Now let's talk relevant costs. These are strictly future incremental cash flows. I honestly cannot emphasize those two words enough. Future, incremental. The examiner absolutely loves to bury sunk costs, like market research you've already done or machinery you've already bought, deep into the scenarios just to waste your time and destroy your calculations. Listen to me. If it's already spent, it is sunk. Ignore it completely and move on.
Let's keep this intense pace going. Notice how quickly we can switch contexts here, just to prove your memory works. In advanced performance management, dysfunctional behavior means gaming the system, short-termism, or budgetary slack. Now, switching to tax, BARDR, that's business asset disposal relief, means a 10% rate up to a $1 million lifetime limit. Back to PM, shutdown decisions. We only shut down if the avoidable fixed cost savings are strictly greater than the lost contribution. Snap, snap, snap. That is exactly how fast your recall needs to be. So, why do good students fail ACCA exams? Think about that for a second. They know the formulas, they've read the books, so why do they get 48 or 49% and fail? Well, it's because they walk blindfolded right into the examiner's favorite traps. Let's fix that right now.
Which brings us to Section 2, Common Exam Mistakes and Fixes.
This is your ultimate shield. We're bringing the energy right back up to maximum, because here is where you secure those extra 5 to 10 passing marks that will literally flip a fail into a solid pass. A classic, heartbreaking rookie error in APV calculations is using the WACC to discount the base case NPV. Doing that drops easy marks instantly. The brilliant fix? Base NPV must always be discounted using the ungeared cost of equity, or KE. Do not let financial leverage contaminate your base case. Separate it out.
Now here is a massive trap in performance management. The mistake is spotting a target costing gap, doing the calculation, and just stopping. You calculate the gap is $10 and you move on. No! The fix here is you must always recommend value engineering actions to close it. Standardize components, substitute cheaper materials, simplify the design. If you stop at the math, you're literally leaving half the marks sitting right there on the table.
So the crucial point here regarding divisional performance is this absolute examiner favorite. The mistake is blindly trusting return on investment, or ROI. You see, ROI tricks managers into sub-optimization. They'll reject a great project just because its return is slightly lower than their current division average, even if it completely beats the corporate cost of capital. It's crazy. The fix? Use residual income, or RI. RI gives you an absolute monetary amount and is the ultimate savior for making decisions that actually align with shareholder value.
Okay, if you're taking the UK tax paper, do not ever mix these two up. The mistake is treating exempt VAT supplies as if they're zero-rated. They are totally different beasts. The fix is knowing that zero-rated means the tax rate is 0%, but you can still recover your input VAT on purchases. Exempt, on the other hand, means there is absolutely no input VAT recovery allowed. Hit that distinction like a hammer in your mind so you never, ever mix up input recovery rules again.
Moving on to our final phase, Section 3, Practice Strategy.
We're shifting from defense straight to offense. You have the rapid-fire triggers, you know the traps, but how are you actually going to spend your final 48 or 72 hours? I need you to follow these 3 exact steps. Step 1. Attempt the objective test questions and mocks in the ACCA free practice platform. Step 2. The timer is on. No pausing to check a textbook, no pausing to grab a coffee. You absolutely must simulate the brutal reality of the exam hall to build your stamina. And step 3, review your mistakes deeply, because honestly, that is where the actual learning happens.
I want you to screenshot this golden review template right now. Seriously, do it. For every single question you get wrong from here on out, you're going to do a forensic breakdown. What was the question? What was your answer? What was the correct answer? Why were you wrong? Was it a math error or a concept gap? And finally, what is the fix? If you use this framework for everything, your scores will absolutely skyrocket.
Now, let's look at this incredible rule and really build your confidence. Show all workings. Even if the final number is completely wrong, method marks count. Listen, the examiner is not your enemy.
They actually want to pass you. If you multiply by the wrong tax rate in step 1, but your logic for steps 2, 3, and 4 is perfect, you are getting those marks. You just have to show your logical steps. Do not just write down a naked final number. Here is an exclusive insider tip just for you in these final, high-pressure days. Take screenshots of the MCQs you get wrong. Create a dedicated album on your phone. Then revise them every single morning the minute you wake up and every single night right before you go to sleep. What you're doing is training your brain's pattern recognition. When you finally sit in that exam hall, your brain will instantly recognize the shape of the questions that used to trick you. It's a real game changer.
0. There is absolutely zero negative marking in ACCA. You must never, ever, under any circumstances, leave a question blank on the practice platform or in the real exam. If you're down to the last 10 seconds, just guess. A blank answer is a guaranteed 0. A guessed answer? That's a 25% chance of a mark. Leave nothing blank.
Okay, take a deep breath. You have the tools, you understand the triggers, you know the traps, and you have the practice strategy. Now, you just need to apply them with absolute confidence. The hard work is already done. Now, you just need to execute. Go in there and pass this exam.
So I leave you with this final provocative challenge. Will you let the examiner's traps beat you, or will you use your mistakes right now to guarantee a pass? Get off this explainer, log right into the practice platform, start that timer, and go attack your mock exams. You've totally got this. Hey, keep failing those tricky performance management pricing questions? Well, let's fix that right now. The fatal flaw ruining your answers, traditional costing, massively overprices your high-volume products. It's a total trap.
See, traditional costing clunkily uses basic labor hours for everything, completely lacking the precision we need.
So, the ultimate exam fix? You've got to switch to activity-based costing, or ABC, instead. The real secret here? Cost drivers. Actual activities, like machine setups, literally drive those overhead costs.
Just memorize this exact flow. Identify the activities, calculate the driver cost, then assign it to products.
So, dividing 100,000 pounds by 500 machine setups gives exactly 200 pounds per setup.
All right, but listen up. Here is the massive catch you absolutely cannot afford to miss.
ABC stops you from dangerously underpricing complex products. It literally gives the most accurate cost possible.
Want to pass PM today? Go download my paid notes right now. Master this before exam day. Newsflash, in 2027, the ACCA syllabus is getting a massive, revolutionary redesign. Are you ready?
Okay, let's dive into this. The global finance landscape is shifting fast, demanding totally new skills.
Traditional number crunching is fading out, quickly getting replaced by AI, big data, and ESG.
ACCA's solution is Accountancy Redefined. It's a brand new focus, heavily prioritizing people, planet, and prosperity.
Enter Essential Employability Modules. These are mandatory, interactive assessments testing real-world workplace skills along your journey.
And this brilliantly illustrates how these new modules seamlessly map to every single level of your ACCA progression.
They'll inject highly marketable skills right into your portfolio. We're talking AI, data science, and sustainability reporting.
Let's see how this builds. We're ditching traditional rote learning for modern strategic tech fluency.
There's even a brand new data science professional exam letting you fully specialize in analytics.
Get this wild fact. Eventually, up to 6 months of practical experience can be met through optional modules. So, what does this actually mean for your career, earning potential, and global mobility? This update isn't a hurdle. It's literally your ultimate career survival guide for mastering ethical, AI-driven leadership. So, the crucial point is, from 2027, ACCA is introducing mandatory essential employability modules covering data, tech, and sustainable leadership.
Will you be caught off guard in 2027? Don't get left behind. Subscribe for more updates.
Let's dive right into this massive going concern trap that's literally costing you ACCA exam marks.
So you spot a client struggling with cash flow, and boom, you identify a going concern risk.
You remember ISA 570, right? You got to check for at least 12 months of operational viability. But here's the trap. Stopping there is exactly where most students completely fail the examiner's test. The absolutely crucial missing step is asking, is the material uncertainty adequately disclosed in the notes?
See, this single question creates a really strict fork in the road for your final audit.
If it's adequately disclosed, you just issue an unmodified opinion plus an emphasis of matter paragraph.
But if that disclosure is hidden, the outcome completely flips to a qualified or adverse opinion. Got multiple uncertainties? That actually triggers a full disclaimer of opinion. It's a huge difference.
Never ignore the financial disclosures when dealing with going concern.
Your final audit opinion completely depends on whether the material uncertainty is adequately disclosed or hidden.
Download my paid AA notes. You'll never fall for this tricky exam trap ever again.
Let's talk about a massive, easily avoidable trap in your ACCA AA exam.
Never write that you are only testing quantities during an inventory count in your AA exam.
You must always include specific procedures for testing cutoff and reviewing for damaged or slow-moving
Items to get full marks. Plus, grab my paid AA notes to guarantee that pass.
So why exactly does just counting items fail to get you those easy marks? Well, counting only proves existence. It just shows the stock is physically in the warehouse.
But the examiner also wants a valuation. Damaged goods mean the net realizable value drops.
And don't forget cutoff. Are those counted goods recorded in the right accounting period?
Let's quickly compare a completely wrong exam answer with a perfectly right one.
A common mistake is just writing check inventory quantities. Guys, that literally scores 0 marks.
The fix? You gotta specifically state your testing cutoff and reviewing for damaged, slow-moving items. This perfectly illustrates the 3 distinct phases of an inventory count under ISA 501.
You literally must break your audit procedures into 3 chunks: before, during, and after. Before the count, you're reviewing instructions and planning test counts for those slow movers.
During the count, observe procedures and record the absolute last goods received and dispatch numbers.
After, use those exact numbers to verify cutoff and follow up on that damaged inventory.
Now, let's see how this ties into the examiner's absolute favorite, the DIRT framework.
DIRT stands for Deficiency, Implication, Recommendation, and Test of Control. Always use this structure. And please, use active verbs like inspect or observe. Never use vague words like check.
So remember this golden rule. Inventory count equals before, during, and after. Easy, right?
Master these exact specifics to pass, and seriously, grab my paid AA notes to crush it.
Are you ready to stop losing easy marks and finally ace your AA exam?
Let's jump right into the massive trap that's constantly causing students to fail their ACCA audit exam.
Look, the pass rate is a stubbornly low 39%. We've got to fix this right now.
So why do 61% of you fail, even when writing completely beautiful, well-structured paragraphs?
The biggest trap? You're confusing business risk with audit risk, and it's absolutely costing you marks.
Writing about falling demand or lost profits? That's just a business issue, so it scores 0.
Examiners actually want to know what could cause a material misstatement in the financial statements.
Another trap? Telling management what to do. You have to specifically state the auditor's response.
Okay, picture this classic exam scenario. A brand new product line is sitting unsold in the warehouse.
If you say unsold stock damages profits, that's a business risk. You literally get 0 marks.
The correct move? Linking that unsold stock directly to an overstatement of the inventory balance.
Here's the exact 5-step structure you need to use to actually get full marks on this.
Never write an audit procedure without stating the exact assertion you are testing.
Whether it is completeness, existence, or valuation, always link your test directly to an assertion or you will lose the mark.
Grab my paid AA notes. Seriously, don't fall for the trap. Let's beat that pass rate.
Let's jump right into this explainer and fix the exact mistake that's killing your ACCA audit score. You understand the business scenarios perfectly, right? So why are you still scoring 0 on the exam? Well, it's not because the exam is too hard. You're just answering the wrong question entirely. And honestly, that brutal 39% pass rate proves this isn't just some minor issue. Examiners literally tell us candidates spot the right issue, but describe a risk to the company. See, business risk is a broad commercial problem. That is definitely not what the examiner wants. Writing a beautiful paragraph about declining profits or losing customers, yeah, that gets you exactly 0 marks. The crucial point, you absolutely must explain what could go wrong in the actual financial statements. Cash flow struggles are business risks, but overseeded receivables? Boom, now that's a true audit risk. Every single risk you write must link to a specific accounts balance and a specific assertion. Here's another trap. Don't write what management should do. Always write what the audit team should do. If your response says the company should, it's 0, always start with the auditor will. Using these 5 steps builds a rigid skeleton for your answers to practically guarantee full marks. Ditch commercial phrases like may decline. Use financial words like overstated or misclassified to secure marks. You've got to memorize these exact assertions, pick the right one for the scenario, and write it down. The gap between passing and failing, it's often just this one structural mistake repeated over and over. So, will you keep writing business risks for 0 marks, or apply this formula to finally pass? Welcome to this explainer. Today, we're stepping right into the high-stakes shoes of an advanced tax advisor. Because let's face it, you aren't just here to crunch numbers, right? You're here to completely master the UK Advanced Taxation Exam, the ACCA ATX. We're going to take what looks like a massive mountain of complex tax legislation and transform it into a high-yield strategic playbook that you can deploy straight onto your exam paper. When you sit down for this exam, the examiner is looking for you to view the entire tax landscape holistically. So let's build that mindset right now. And honestly, it all starts right here with the ultimate advisor question. Picture this. A new client walks through your door. This is the very first foundational choice you have to make. Do they operate as a sole trader, or do they incorporate as a limited company? It seems simple, but this single decision dictates their tax rates, their personal liability risk, and exactly how they can extract their hard-earned cash. Get this wrong, and you've literally cost them thousands before the business even gets off the ground. So here's our game plan for today. We'll run through 3 strategic plays. Play 1 is entity and remuneration. Play 2 covers losses and capital gains. And finally, play 3 tackles ethics and administration. Right, let's jump straight into play 1, the foundations. We're talking entity and remuneration. Okay, I want you to keep this number firmly in your mind, £50,000. This right here is your crucial profit pivot point. You see, when a sole trader's profits consistently cross that $50,000 mark, they hit the higher rate income tax band, and suddenly they might start losing valuable allowances. At this exact point, transitioning them to a limited company almost always becomes a smarter, more tax-efficient play. Why? Well, because a company allows you to shelter those profits at much lower corporate rates, meaning you can reinvest the cash directly back into the business instead of handing 40% of it straight over to the taxman. Let's actually look at how those mechanics differ head-to-head. On the sole trader side, your client is getting hit with income tax rate scaling from 20 up to 40 or even 45%, plus Class 2 and Class 4 national insurance. Now, the upside? It's a much simpler administrative setup, and they generally qualify for a full 100% business relief for inheritance tax. But look at the limited company side. They enjoy much lower corporation tax rates, between 19 and 25% on retained profits. But here's the catch. That money belongs to the company, not the individual. So to actually get that cash in your client's pocket, you have to carefully extract it using a tactical mix of salary and dividends, which, as you can see, carry their own distinct tax rates. Which brings us to another magic number, £9,100. This is the optimal director's salary threshold for the 2025/26 tax year. So why is this specific figure so absolutely critical? Because paying a salary exactly up to this secondary national insurance threshold is basically the ultimate tax sweet spot. The business gets a legitimate, tax-deductible expense that lowers its corporation tax bill, but, and this is the best part, the taxman gets absolutely nothing in national insurance. Neither the employer nor the employee pays a single penny. Notice the layered approach we're using here. It's like stacking building blocks to create the ultimate remuneration package. First, you lock in that £9,100 salary to completely dodge national insurance. Next, you utilize the remaining personal allowance up to £12,570, where 0 income tax is applied. Finally, you sweep the rest of the required cash out as dividends, right up to the basic rate band limit of £37,700. This incurs a highly efficient 8.75% dividend tax and, again, 0 national insurance. It's a perfect, totally legal optimization of the tax brackets that examiners absolutely love to see. So, lock this one-line summary in for exam day. Take the salary to the NI threshold and balance the rest as dividends. Oh, and here's a massive high-yield bonus tip for your advisory arsenal. If your director wants a company car,
always recommend an electric vehicle. That secures an incredibly low 2% benefit in kind rate. It's a huge saving compared to traditional petrol or diesel cars, and throwing that in shows the examiner you are thinking practically about modern tax planning. Okay, moving right along to Play 2, damage control, losses, and capital gains. Look, in business, things go wrong. And when a business takes a hit, you need a really powerful damage control strategy. Trading losses are incredibly flexible. You can carry them back up to 3 years, up to a limit of £2 million. That generates an immediate physical cash refund from HMRC. It's a total lifeline for a struggling business. Terminal losses, those occurring in the final 12 months of trading, can also be carried back 3 years, though strictly against trading profits. But watch out for the capital loss trap. Capital losses cannot be carried back. No way. They are strictly carried forward, waiting indefinitely with no time limit to offset future capital gains. Now, beyond damage control, we have wealth preservation. When dealing with capital gains, reliefs are your best friend. For example, if a client lets out part of their main home, principal private residence, or PPR, letting relief can wipe out up to £40,000 of the chargeable gain. On the commercial side, if they're passing the business torch to the next generation, gift holdover relief is what you want. It completely defers the gain by simply passing the original cost base to the recipient. The tax bill is essentially frozen in time until the new owner actually decides to sell the asset. Make sure you keep this anchor firmly in mind. Trading losses equal immediate cash flow via a 3-year carryback, and holdover relief defers capital gains on business assets. Mastering these two distinct tools guarantees massive exam marks because they prove to the examiner that you can manage both immediate cash flow crises and long-term succession planning. All right, let's jump into our final section, Play 3, playing by the rules. We're talking ethics and administration. Listen, knowing the math is totally useless if you cross ethical boundaries. You must strictly distinguish between avoidance and evasion. Tax avoidance is legal. It's smartly using the rules and reliefs provided by the government to your client's advantage. Tax evasion, however, is the illegal concealment or misrepresentation of information. The golden rule here: you must never, under any circumstances, assist in evasion. Furthermore, ACCA guidelines explicitly forbid promoting aggressive, artificial avoidance schemes that clearly go against the spirit of the law. This all maps directly to the ACCA Code of Ethics. You must act with integrity, meaning absolutely no fraudulent planning, work within your professional competence, maintain strict confidentiality regarding your client's affairs, exhibit professional behavior by complying fully with HMRC, and critically, if a strategy falls under DOTAS, the disclosure of tax avoidance schemes, it is your legal obligation to ensure HMRC is formally notified. They want to know about these loopholes immediately, and failing to report them puts your entire professional standing at immense risk. And you know, a huge part of that professional behavior is hitting strict administrative deadlines. The personal tax year always ends on April 5th. Now, if your client insists on submitting a paper return, October 31st is the cutoff. But for the vast majority who are filing online, January 31st is the ultimate deadline for both submitting the return and making the balancing payment. Miss that midnight chime on January 31st, and you instantly trigger HMRC's penalty machine. Because let me tell you, when things go wrong, HMRC's powers are formidable. They can issue sudden information notices demanding your client's records. If they suspect hidden or lost tax, they'll launch discovery assessments, allowing them to look back years into a client's history. Late filing earns an automatic £100 fine before the daily penalties even start piling up, but the absolute worst offenders face inaccuracy penalties, which scale dramatically, from 0 all the way up to 100% of the lost tax, and that depends entirely on whether the error was just a careless mistake or deliberate with a concerted effort to conceal the evidence. So let's firmly cement the difference before we wrap up. Ethical tax planning is smart, legal, and fully disclosed. Evasion is a crime, and self-assessment deadlines are absolute. Keep your clients compliant, and you keep them, and your own professional license, out of trouble. The examiner just wants to see that you are a safe pair of hands. And that brings us to the examiner's ultimate rule for the ATX. Advise, don't just calculate. A mathematically flawless tax computation is practically worthless if you don't actually tell the client what to do, outline the risks, and uphold the strict ethical boundaries of our profession. But as tax legislation grows more complex and layered every single year, ask yourself, where does the line between clever strategic advice and aggressive avoidance truly sit in tomorrow's economy? Thanks so much for joining me on this explainer. Keep pushing those boundaries and good luck mastering the playbook. Right, let's just jump straight into this explainer. Today, we're demystifying some of the absolutely critical parts of the ACCA ATX syllabus. We're going to navigate the incredibly complex borders of international tax and then bring it back home for domestic advanced VAT. Honestly, if you've been banging your head against the wall with the overseas aspects of taxation or those finicky VAT rules, you are in the exact right place.
Picture this. Your high net worth client walks into your office. They're pulling in serious money abroad, but they're also running a highly profitable UK business on the side. So what actually happens when these tax borders collide? Well, today we're going to map out exactly how to untangle their overseas tax liabilities and, at the same time, cure their UK VAT headaches. Ultimately, while making sure you know exactly how to secure those high-level exam marks.
So, here is our game plan. 1. Crossing borders and double tax. 2. Non-DOMs and the remittance basis. 3. VAT, specifically partial exemption and the CGS. And 4. VAT special schemes. Let's get to it. Section 1. Crossing borders. Double tax relief. Let's kick things off with the very real nightmare of your high net worth client getting taxed twice on the exact same income. Double taxation is just a massive penalty for global clients, so knowing how to relieve it is completely fundamental to advanced tax planning. When we break down the 3 main relief methods, the options are actually pretty clear-cut. First, you've got the exemption method. This is where foreign income simply isn't taxed in the UK at all, though that's only used in some specific treaties. Then there's unilateral relief, which is basically the UK stepping up to give a credit even when no formal treaty exists. But the most common method, by a mile, is the credit method. This is where the foreign tax paid is deducted directly from the UK tax on that very same income. However, there is an absolute limit here that you can never, ever forget. And here is that crucial one-line mental trigger. Double tax relief equals the foreign tax credit. Sure, but, and this is a huge but, it is strictly limited to the UK tax on that specific income. You literally cannot claim more than the UK tax liability. So, say the foreign tax is $2,000, but the UK tax on that specific slice of income is only $1,500, well, your credit is hard capped at $1,500. Burn this rule into your memory for the exam so you don't accidentally overclaim your client's relief. Moving right along to Section 2, non-DOMs and the remittance basis. Now we're dealing with the individuals crossing these borders. Let's tackle the notoriously tricky rules for your non-domiciled clients who are keeping their wealth offshore. The examiner absolutely loves testing this area, so we need to be sharp. Okay, so the remittance basis. It basically means foreign income and gains are only taxed when they're physically brought or remitted into the UK. It is the ultimate tax trade-off. Yes, your client can shield their overseas money from HMRC, but the moment they claim this, they instantly sacrifice their standard UK tax-free allowances. That means their personal allowance? Gone. Capital gains annual exempt amount? Poof, disappears. And you know what? The costs don't even stop at lost allowances. Let's say your client has been a UK resident for 7 of the last 9 tax years. If that's the case, they get hit with this massive remittance basis charge. We're talking a flat $30,000 annual toll they have to pay, just for the privilege of keeping their offshore wealth untaxed. And it gets steeper. If they stretch that residency boundary even further, say remaining resident for 12 of the last 14 years, that charge literally doubles to $60,000. At that point, you really have to sit down, run the numbers for your client, and figure out, is paying this massive flat fee actually cheaper than just biting the bullet and paying the UK tax on the foreign income? Now, listen up, because this next part is a huge update, specifically for the June 2026 syllabus. The deemed domicile threshold has been severely tightened. It used to be 15 years, but it's now dropped down to just 10 years of UK residence. The second your non-dom client hits that 10-year mark, bam, they are deemed domiciled in the UK for tax purposes, and that protective offshore boundary completely vanishes. All right, Section 3, VAT, partial exemption, and the CGS. Let's shift our client's focus to domestic borders. We're looking at how this builds into advanced VAT. Specifically, navigating those really blurred lines between taxable and exempt business supplies. Because once a business starts doing both, VAT recovery gets incredibly complicated. The golden rule is that you can generally only recover input VAT that's related to taxable supplies. But there is a vital exception we need to talk about, the de minimis test.
For this to apply, the exempt input VAT has to be greater than £7,500 per year, and, this is the kicker, it must be greater than 50% of the total input VAT. This is such a classic exam trap. Both of these strict conditions have to be broken to restrict VAT recovery. If your client only breaks one, good news, they can still recover everything. So, keep this golden one-liner handy for partial exemption. It perfectly neatly partitions your taxable and exempt inputs. If they sit below those de minimis limits, treat the whole lot as recoverable. But if they blow past both limits, you've got to strictly apportion it.
Okay, but what happens when a business buys a massive, expensive asset that gets used for both taxable and exempt purposes over a long period of time? Enter the Capital Goods Scheme, or CGS. The CGS basically forces us to monitor specific timeframes, adjusting VAT recovery if how the asset is used changes over time. Notice the split here. Computer equipment, that's adjusted over a 5-year period. But expensive stuff like land and buildings, that gets monitored over a full 10-year period.
Let's actually walk through the mechanics of this, step by step, because it's a brilliant illustration of that in action. Imagine your client buys a building for a cool £1,000,000, which generates £200,000 of input VAT. In year 1, they use it 100% for taxable supplies, so they happily recover the entire £200,000. Easy, right? But then in year 3, their business model shifts. They start making more exempt supplies, and their taxable use drops to 80%. This is where the CGS steps in. We take that original £200,000 of VAT, multiply it by the 20% drop in taxable use, so 80% minus 100%, and boom, we see that simply shifting the building's usage physically claws £40,000 right back to HMRC, which is then spread out over the remaining years of that 10-year period.
Which brings us nicely to Section 4, VAT Special Schemes Simplified. Finally, let's explore the regulatory boundaries of these special schemes. Because, honestly, standard VAT rules can be an absolute administrative nightmare for smaller business ventures. So HMRC offers these alternative boundaries to help streamline compliance. These turnover limits are absolute gold for picking up easy exam marks. For cash accounting, if the turnover is under £1.35 million, your client gets a huge cash flow benefit. They only pay VAT to HMRC when their customer actually hands over the cash. For annual accounting, the limit is the same, £1.35 million, but the perk is pure admin relief, just one single VAT return a year. And then you've got the flat rate scheme. You can join if turnover is up to £150,000, and you can stay in it until you hit £230,000. With this one, you just apply a fixed percentage to your gross turnover. No tracking individual input VAT invoices. The whole shebang is simplified.
So lock this summary in your brain right now. It perfectly categorizes exactly how each special scheme alters the normal VAT mechanics. When you get a scenario question where you have to advise a struggling small business, these are the exact tools you're going to pull out of your toolkit.
Wow, okay, we've covered a serious amount of ground today, from international double tax relief limits and tightening non-dom rules, all the way down to the strict math of the capital goods scheme and VAT thresholds. But I want to leave you with a final thought on your overall client strategy. As you master all these complex relief and VAT mechanics, you have to ask yourself, how are you going to advise your clients to maximize their wealth without stepping over that final invisible boundary into aggressive avoidance? The legislation gives you the map, sure, but it is your rigorous understanding of these ACCA ATX boundaries that guarantees your advice is fully compliant, legally sound, and highly effective. Thanks so much for joining me on this explainer, and I will see you in the next one.
All right, let's dive right into this explainer and finally demystify those highly technical UK corporation tax rules. We're going to do this by following the actual life cycle of a corporate group. If you're prepping for the ACCA ATX exam, or honestly just trying to wrap your head around how corporate tax works in the real world, you already know the rules change completely the second a single company joins a larger group. So today, we're unpacking the exact mechanisms that let companies share their losses, move assets around tax-free, and even sell off whole subsidiaries without taking a massive tax hit.
Our roadmap for today covers 5 really complex ATX topics. We're literally going to follow the timeline of a business. We'll start with forming a group to share that initial burden, then look at expanding internationally, and eventually closing down a trade altogether.
Okay, Section 1. Group and consortium reliefs, sharing the burden.
So we're in the formation phase. A parent company is just starting to acquire subsidiaries. The immediate massive benefit here is how these groups can share their losses to slash the overall corporate tax bill. The magic number to remember is 75%. If a parent owns at least 75% of a subsidiary, whether that's directly or indirectly, boom, you've created a 75% group. And this is literally a golden gateway. It lets you freely surrender trading losses, management expenses, and even non-trading loan relationship deficits, which is really just a fancy way of saying losses from investments or loans. Think about it like this. If the parent company loses $100,000, but the subsidiary makes $200,000 in profit, the parent can just surrender its loss over. The subsidiary then only pays tax on $100,000. You can pass over all of it or just a part of it. It's a total game changer for cash flow. Just keep in mind you absolutely cannot surrender capital losses here.
But what if you just don't hit that magic 75% mark? Well, that's where consortiums come in. Sometimes companies team up but keep a smaller stake. A consortium happens when a company is owned by 5 or fewer companies and each holds at least a 5% slice. Now, you really have to watch the math here. While 75% groups share their losses completely freely, consortiums are on a much tighter leash. They have to surrender losses strictly in proportion to their shareholding. So if you only own 20% of the consortium company, you can only grab 20% of its surrendered losses.
Moving right along to Section 2, Asset Transfers and Degrouping, Moving Assets Around. All right, so our group is up and running, and we're sharing losses. But here's a huge question for tax planners. What happens if you need to move a building, a valuable patent, or a massive piece of machinery from one subsidiary to another? Does that trigger some huge capital gains tax bill? I mean, if you're just shuffling assets for operational efficiency, paying tax on that would completely wreck your cash flow, right?
Thankfully, the answer is no. Enter the brilliant no gain, no loss rule. Assets transferred between 75% group companies are treated as completely tax neutral. The company giving the asset makes zero gain and zero loss. The company receiving it just takes it over at the original cost base. So say the parent bought an office building for £1 million 10 years ago and transfers it to a subsidiary today when it's suddenly worth $3 million. The subsidiary just inherits it at that original £1 million cost. It's one of those rare, beautiful moments where HMRC just gives you a free pass to optimize your business.
But hold on, you've got to be careful. HMRC isn't stupid. They don't want you stuffing highly valuable assets into a subsidiary just to sell that subsidiary off completely tax-free. So there is a critical 6-year high alert window for what's called a degrouping charge. If you transfer an asset tax-free, and then that subsidiary leaves the group within 6 years, bam, a deferred gain is suddenly triggered. It's calculated as if the asset had been sold at market value back when the transfer originally happened, and that massive tax charge falls right on the company leaving the group. If you trigger that by accident, it is a nightmare. Make it to your 6th, though, and you're totally safe.
Which brings us to Section 3, the Substantial Shareholdings Exemption, or SSE, selling off subsidiaries.
Let's say your group is maturing and decides to restructure by selling off a whole subsidiary to a third party. This is where we hit one of the absolute most powerful reliefs in the entire UK tax system, 10%. That is the absolute minimum ordinary shareholding you need to even unlock this relief. You do not need a full 75% group to get SSE. Holding just a 10% slice of shares in another company is enough to get your foot in the door, which makes it incredibly accessible for things like joint ventures.
Now, to actually pull off this magic trick and turn what would be a massive taxable gain into a completely tax-free cash injection, you have to perfectly execute 3 golden rules. First, hold at least 10% of the ordinary shares. Second, you have to hold those shares continuously for at least 12 months within the 2 years right before you sell. And third, the company you're selling, the investee, must be a trading company, or at least the holding company of a trading group. It absolutely cannot be just some passive investment vehicle holding property.
If you check all 3 of those boxes, the result is staggering. Complete exemption. Zero corporation tax on the chargeable gains from selling those shares. Seriously, if you memorize one thing for your ATX exam, make it this. SSE equals 10% plus holding, 12 months, trading company, leads to the game being exempt. Lock that into your brain. It's a cornerstone of corporate tax planning.
All right, Section 4, Transfer Pricing Fundamentals, International and Intergroup Pricing. As our group continues to grow, cross borders, and expand operations, we inevitably crash into the heavily scrutinized world of transfer pricing. The whole point here is to stop profit shifting, because without these rules, a UK company could just sell goods to its own subsidiary in some low-tax haven for practically pennies and shift all the profit out of the UK. The arm's length principle stops that dead. It says that any price charged between connected group companies has to be exactly what two independent, unrelated parties would agree on in the open market. Try to cheat that and HMRC will step right in and adjust your profits back to reality.
And complying with transfer pricing? It is no joke. It's complex and expensive. The burden really comes down to company size. Large groups face a mountain of documentation. They have to prep master files, local files, often hiring expensive economists just to justify their pricing models. Get it wrong, and the penalties are steep. But here's the good news. Small companies with less than £10 million in turnover get a vital exemption from all of this, as long as they aren't deliberately engineering a tax advantage. It is a massive sigh of relief for growing businesses.
And that brings us to Section 5, Terminal Loss Relief, closing down a trade.
We've reached the end of the line for our business life cycle, closing up shop. When a trade finally ceases, it usually generates one final, really painful loss. The tax system actually recognizes this and throws you a lifeline called terminal loss relief. Now, a terminal loss is specifically the trading loss generated in the final 12 months. But unlike standard carry-back rules that only look back 1 year, you can actually carry a terminal loss back 3 full years, starting with the most recent year first. There is a catch, though. You can only set it against past trading profits, not other income, not capital gains. But still, it's an absolute lifesaver to generate a cash tax refund right when the closing company needs it most to pay off those final creditors.
Now, wrapping this all up, throughout this entire journey, from sharing group losses and moving assets to claiming the SSE, as a tax planner, you are strictly bound by the ACCA Code of Ethics. You have to act with absolute integrity, meaning zero involvement in fraudulent tax planning. You must maintain professional competence, so only advise on things you actually understand. And professional behavior means strictly following HMRC rules and being entirely transparent.
Which brings us to a massive, absolute boundary every single professional has to navigate: the line between avoidance and evasion. Tax avoidance is legal. It's minimizing tax within the law. Now, if it's super aggressive, you do have to disclose it to HMRC under the DOTAS rules, but tax evasion, that is illegal concealment. It's lying. And as a professional, evasion is a line you simply never cross, never promote, and never assist with. We've covered a ton of ground today, tracking the entire life cycle of a corporate group through the incredibly complex lens of UK tax law. So as you go out to apply these rules in practice or tackle them in your exams, I want to leave you with a thought. When you're using group reliefs, timing those degrouping charges, or setting transfer prices, where exactly is the line? Is your brilliant tax strategy genuinely serving the natural business life cycle, or are you just aggressively gaming the system? Figuring out that difference, that's what makes you a truly expert tax professional. Thanks so much for hanging out with me for this explainer.
Welcome to This Explainer. Today, we're taking the incredibly dense rules of ACCA Advanced Taxation, specifically the UK Finance Act 2025-26 syllabus, and transforming them into a highly actionable strategic playbook. We're building what I love to call the wealth fortress for your clients, just in time for those June 2026 exams. We're going to look at exactly how to protect a lifetime of hard-earned capital from HMRC using the precise tax planning techniques the examiner actually wants to see. Here's our agenda. We'll be covering protecting the wealth fortress, business and agricultural reliefs, gifting rules and installments, the pension allowances squeeze, and finally, the post-LTA pension era. Basically, we're dividing this whole syllabus into 2 distinct pillars: pass it on via inheritance tax reliefs and cash it out through advanced pension planning. Now keep this one-line summary directly from your revision notes in the back of your mind. ATX equals complex reliefs, groups, overseas, and tax planning. Basic calculations might get you through standard taxation, but advanced taxation, it's literally all about those complex reliefs, overseas aspects, and strategic tax planning. Today is all about navigating those exact reliefs and, crucially, avoiding those hidden exam traps. Section 1, Protecting the Wealth Fortress. All right, let's dive right in and establish our first pillar, focusing purely on wealth preservation and inheritance tax strategies. When a client builds a massive estate, the default is a really heavy IHT burden. Well, our job is to legally dismantle that burden. Moving on to Section 2, Business and Agricultural Reliefs. We're starting here by looking at how to literally zero out a massive inheritance tax bill using business relief, or BR, and agricultural relief, AR. These are incredibly powerful tools that can completely wipe out the tax on eligible assets. Now, a massive exam trap you absolutely have to watch out for is knowing exactly when a client gets 100% business relief versus just 50%. It's a huge difference. So if your client is a sole trader, part of a partnership, or holds shares in an unquoted trading company, boom, they get a massive 100% relief. The value is completely wiped out for IHT. But, and here's the catch, if they hold a controlling interest of more than 50% in quoted trading shares, or they personally own land and buildings used in their business, well, that relief is instantly slashed in half to 50%. You absolutely must spot this difference in your exam scenarios. Moving over to agricultural relief, we see a very similar dynamic. For AR, 100% relief is granted for agricultural property occupied by the owner for farming. But if that property is let out on a tenancy, it drops straight to 50%. Now here is the absolute golden rule of interaction to remember. If an asset qualifies for both agricultural relief and business relief always applies first if it yields a higher relief. Always test BR first. But look, you don't just get these generous reliefs automatically. Both of them require the asset to be held for a strict minimum holding period of exactly 2 years before the transfer. Miss that by a single day, and honestly, the fortress crumbles. Oh, and note this specific exception. Tenanted agricultural land actually requires a much longer 7-year holding period, unless, of course, there are special succession rights involved. Section 3. Gifting rules and installments. So what actually happens when clients try to prematurely pass on their wealth through gifting to bypass these rules entirely? Let's take a look. Well, this brings us to a classic cautionary tale that the examiner just loves to test. Gifts with reservation, or GWR. Let's say a client tries to game the system by gifting a house to their kids, but they keep living in it rent-free. Yeah, that triggers the GWR rules. The result? That property remains firmly inside their estate for IHT purposes, completely blowing up your tax strategy. The reservation basically continues until the donor either stops using the property or dies. To properly navigate this minefield without getting penalized, you've got to look at the exceptions. If your client really wants to gift that house and live in it, they have to pay full market rent to the new owner. That breaks the reservation. Alternatively, the rules don't apply to excluded property. So for non-domiciled individuals, their overseas assets are considered excluded property, meaning they sit entirely outside the UK IHT net anyway. Now, even with great planning, sometimes a taxable event does occur, like a transfer into a discretionary trust, and suddenly cash is tied up in illiquid assets. Here, the 10-year installment option can literally be a lifesaver, letting you pay the IHT in 10 annual chunks. But pay close attention to the stark contrast in interest rates here. If you're paying in installments on business assets or unquoted shares, the interest is 0%. I mean, zero. It's essentially free financing. But for land and buildings, you get hit with the standard interest rate, which is currently sitting at 3.25%. So you've successfully protected your estate for your heirs using BR, AR, and some really smart gifting. But wait, how do you protect your own capital for your retirement? It is time to pivot our focus to the second pillar of our wealth fortress. Section 4, the pension allowances squeeze. Welcome to the cash it out pillar, where navigating pension allowances requires some seriously meticulous planning, especially for your high earners. We anchor our entire pension strategy on the base annual allowance, which for the 2025/26 tax year is £60,000. You get the basic rate tax relief added at source and higher or additional rate relief through your tax return. Crucially, though, any unused allowance from this £60,000 can be carried forward for 3 years. That is a fantastic planning tool if your client suddenly has a massive spike in income. However, high earners face a pretty severe squeeze, and this brilliantly illustrates the mechanics of the tapered annual allowance. If a client's threshold income breaches £200,000 and their adjusted income goes over £260,000, the standard £60,000 allowance is aggressively tapered down. It reduces by £1 for every £2 over that £260,000 mark. Eventually, it bottoms out at a highly restrictive minimum allowance of just £10,000. Ouch. Similarly, there's another trap that forces clients down to that exact same restrictive level. If a client flexibly accesses their pension early, say, for example, taking an income through drawdown, the Money Purchase Annual Allowance, or MPAA, permanently locks them down to that same $10,000 limit for any future contributions. So you really have to plan around that.
Section 5, the post-LTA pension era. Finally, we absolutely must examine the brand new landscape of the post-April 2024 pension era. If you've been studying old materials, wake up, because you need to pay very close attention here. The old lifetime allowance? It's officially abolished. As of the 6th of April 2024, there are no more LTA charges. None. This means you must completely shift your exam focus away from calculating those old penalties. The rules of the game have fundamentally changed. Instead of that old LTA, I need you to burn this specific number into your memory for the exam: 268,275 pounds. This is the new lump sum allowance, or LSA limit. Tax-free cash is now strictly limited to this exact amount, which, fun fact, is exactly 25% of the old lifetime allowance limit. Any lump sum taken above this specific figure is just taxed at the client's marginal rate. But hang on, before you just go applying that 268,275 cap to everyone, I want to let you in on a little secret the examiner loves to test. Be super careful to check your scenario for transitional protection. If your client holds protection from previous tax regimes, like Fixed Protection 2016 for instance, they legally retain their higher historical allowance amounts. The examiner loves to casually drop this detail into a scenario just to see if you're actually paying attention. As we wrap up this explainer, I really want to leave you with the absolute golden rule for the ATX exam. Do the math, yes, for sure. Calculate that £10,000 tapered allowance. Figure out the 50% business relief. But always follow it up with strategic commercial advice. State the planning points, highlight the commercial risks. The examiner rewards advice, not just arithmetic. So when you sit down in that exam hall in June 2026, ask yourself, have you truly mastered these conditions well enough to protect a lifetime of wealth? Will your client's wealth fortress withstand HMRC, or will a simple missed 2-year holding period bring the whole thing crashing down? Keep reviewing this material, internalize these rules, and you will be absolutely ready to build an impenetrable strategy. Thanks for joining me on this explainer.
Listen to me closely. If your ACCA exam is literally days away and you're feeling totally overwhelmed, just stop right now. Take a deep breath. You are in exactly the right place. Welcome to this masterclass explainer. I'm here to execute a rapid-fire, completely no-fluff rescue mission to get your brain locked in and exam ready. We're cutting out all the noise, dropping the textbook filler, and focusing exclusively on the high-yield, pure signal concepts that are going to drag you across that pass mark. So I need your absolute, undivided focus for the next few minutes. Let's get into it.
I want this to burn into your memory right now. You will learn more from your mistakes than from any notes. Listen, this isn't just some cheesy motivational poster. This is your absolute battle cry for these final hours. Stop passively reading endless pages of text. The ACCA examiner is not going to test your ability to highlight a textbook. No way. They are testing your ability to navigate their traps. And honestly, the absolute fastest way to learn how to dodge those traps? Fall into them right now, figure out exactly why you fell, and make sure you never, ever do it again.
So here is our 3-step game plan to get you exam ready. Number 1, ultra-fast revision. Number 2, common exam mistakes and fixes. And number 3, practice strategy. Let's kick things off with Section 1, ultra-fast revision.
All right, shift your brain into top gear right now. No more long paragraphs. We are hardwiring one-line triggers into your mind so they fire off automatically. Boom, adjusted present value. If you're sitting advanced financial management, this is an absolute must-know. APV literally separates the operating NPV from the financing side effects. You need to instantly generate this formula in your head. Base case NPV plus the present value of the tax shield on debt minus your issue costs plus the present value of any subsidized loan benefits. Drill that exact sequence. Base plus tax shield minus issue plus subsidy. Lock it in.
Okay, let's see how fast we can trigger your recall across different papers. Ungearing beta, you're removing financial risk using 1 minus the tax rate. Target costing, it is always the target selling price minus your desired profit, and you absolutely must close that gap with value engineering. Throughput, it's simply your sales revenue minus direct material cost only, and your entire goal is to maximize it per bottleneck hour. Lock these associations into your brain immediately.
Now let's talk relevant costs. These are strictly future incremental cash flows. I honestly cannot emphasize those two words enough. Future, incremental.
The examiner absolutely loves to bury sunk costs, like market research you've already done or machinery you've already bought, deep into the scenarios just to waste your time and destroy your calculations. Listen to me. If it's already spent, it is sunk. Ignore it completely and move on.
Let's keep this intense pace going. Notice how quickly we can switch contexts here just to prove your memory works. In advanced performance management, dysfunctional behavior means gaming the system, short-termism, or budgetary slack. Now, switching to tax, BAR-DR, that's business asset disposal relief, means a 10% rate up to a $1 million lifetime limit. Back to PM, shutdown decisions. We only shut down if the avoidable fixed cost savings are strictly greater than the lost contribution. Snap, snap, snap. That is exactly how fast your recall needs to be.
So, why do good students fail ACCA exams? Think about that for a second. I mean, they know the formulas, they've read the books, so why do they get 48 or 49% and fail? Well, it's because they walk blindfolded right into the examiner's favorite traps. Let's fix that right now. Which brings us to Section 2, Common Exam Mistakes and Fixes.
This is your ultimate shield. We're bringing the energy right back up to maximum, because here is where you secure those extra 5 to 10 passing marks that will literally flip a fail into a solid pass. A classic, heartbreaking rookie error in APV calculations is using the WACC to discount the base case NPV. Doing that drops easy marks instantly. The brilliant fix? Base NPV must always be discounted using the ungeared cost of equity, or KE. Do not let financial leverage contaminate your base case. Separate it out.
Now here is a massive trap in performance management. The mistake is spotting a target costing gap, doing the calculation, and just stopping. You calculate the gap is $10 and you move on. No! The fix here is you must always recommend value engineering actions to close it. Standardize components, substitute cheaper materials, simplify the design. If you stop at the math, you're literally leaving half the marks sitting right there on the table.
So the crucial point here regarding divisional performance is this absolute examiner favorite. The mistake is blindly trusting return on investment, or ROI. You see, ROI tricks managers into sub-optimization. They'll reject a great project just because its return is slightly lower than their current division average, even if it completely beats the corporate cost of capital. It's crazy. The fix? Use residual income, or RI. RI gives you an absolute monetary amount and is the ultimate savior for making decisions that actually align with shareholder value.
Okay, if you're taking the UK tax paper, do not ever mix these two up. The mistake is treating exempt VAT supplies as if they're zero-rated. They are totally different beasts. The fix is knowing that zero-rated means the tax rate is 0%, but you can still recover your input VAT on purchases. Exempt, on the other hand, means there is absolutely no input VAT recovery allowed. Hit that distinction like a hammer in your mind so you never, ever mix up input recovery rules again.
Moving on to our final phase, Section 3, Practice Strategy.
We're shifting from defense straight to offense. You have the rapid-fire triggers, you know the traps, but how are you actually going to spend your final 48 or 72 hours? I need you to follow these 3 exact steps. Step 1. Attempt the objective test questions and mocks in the ACCA free practice platform. Step 2. The timer is on. No pausing to check a textbook, no pausing to grab a coffee. You absolutely must simulate the brutal reality of the exam hall to build your stamina. And step 3, review your mistakes deeply, because honestly, that is where the actual learning happens.
I want you to screenshot this golden review template right now. Seriously, do it. For every single question you get wrong from here on out, you're going to do a forensic breakdown. What was the question? What was your answer? What was the correct answer? Why were you wrong? Was it a math error or a concept gap? And finally, what is the fix? If you use this framework for everything, your scores will absolutely skyrocket.
Now, let's look at this incredible rule and really build your confidence. Show all workings. Even if the final number is completely wrong, method marks count. Listen, the examiner is not your enemy. They actually want to pass you. If you multiply by the wrong tax rate in step 1, but your logic for steps 2, 3, and 4 is perfect, you are getting those marks. You just have to show your logical steps. Do not just write down a naked final number.
Here is an exclusive insider tip just for you in these final high-pressure days. Take screenshots of the MCQs you get wrong. Create a dedicated album on your phone. Then revise them every single morning the minute you wake up and every single night right before you go to sleep. What you're doing is training your brain's pattern recognition. When you finally sit in that exam hall, your brain will instantly recognize the shape of the questions that used to trick you. It's a real game changer.
Zero. There is absolutely zero negative marking in ACCA. You must never, ever, under any circumstances, leave a question blank on the practice platform or in the real exam. If you're down to the last 10 seconds, just guess. A blank answer is a guaranteed zero. A guessed answer? That's a 25% chance of a mark. Leave nothing blank.
Okay, take a deep breath. You have the tools, you understand the triggers, you know the traps, and you have the practice strategy. Now, you just need to apply them with absolute confidence. The hard work is already done. Now, you just need to execute. Go in there and pass this exam.
So I leave you with this final provocative challenge. Will you let the examiner's traps beat you, or will you use your mistakes right now to guarantee a pass? Get off this explainer, log right into the practice platform, start that timer, and go attack your mock exams. You've totally got this. Welcome to the Explainer. Today, we're tackling a massive trap in your ACCA Business and Technology exam.
Think a company runs in perfect harmony? Honestly, do managers actually want what's best for the business?
And this brilliantly illustrates the core issue. Ownership doesn't equal control. That creates a massive conflict, right?
Okay, let's dive into this. The agency problem hits when managers chase personal wealth over the shareholders' interests. Let's see how this builds. Owners lack daily control, managers make the decisions, so conflict inevitably strikes.
Picture this. A manager rejects a super profitable project just to avoid risk and protect their own job.
Now, what's really interesting here is spotting the examiner's bait. Keywords like conflict, self-interest, incentives, and monitoring. Memorize this pattern. If you see unaligned incentives or monitoring costs on your exam, boom, it's an agency issue.
Don't fall for the first trap. An agency issue is a direct conflict of interest, not just business risk.
Also, don't just call it ethics. The examiner tests this purely as a structural governance conflict around self-interest.
So, the crucial point is this. Agency literally equals the conflict between owners and managers. Lock that in.
Which leaves us wondering, are corporate incentives actually solving this problem or just paying for entirely new ones?
Welcome to today's Explainer. We're dodging a massive ACCA Business and Technology exam trap right now.
So, is a staff mistake a financial risk? This exact question totally wrecks BT exams.
If you said yes, you totally fell for it. It's a huge trap.
Why? Because mixing up your risk categories is literally throwing away easy marks.
The fix? You gotta separate the three main risk categories clearly in your head. First up, a system crash or staff mistake. That's strictly an operational risk. Contrast that with a true financial risk, which actually relates to money, like currency loss.
But hold on, here's the ultimate catch the examiner absolutely loves to use.
Market competition is always a strategic risk. Calling it operational is a massive mistake. Examiners will deliberately swap these exact definitions just to trick you on test day.
They swap these scenarios constantly, so memorize the correct pairings as your ultimate cheat code.
Stop falling for their traps. Master these three specific categories to ace your exam fast.
Grab my paid notes today. But honestly, what other sneaky traps are lurking in your syllabus?
Welcome to this Explainer. For your ACCA exam, which product makes more money? Don't fall for this classic trap. Product A makes 50 rupees profit. Product B only makes 30. You'd instantly pick A, right? Most students do.
But hold on, here's the catch. Relying purely on total profit will absolutely cost you crucial exam marks.
Product A takes 2 hours, making 25 rupees hourly. Product B takes just 1, making 30. B totally wins.
That's limiting factor analysis. Always maximize your cash per unit of your bottleneck, like time. It's the golden rule. Grab your free PDF notes right now. So, what other hidden bottlenecks are secretly draining your true profitability?
Watch out. The IAS 16 property revaluation trap literally ruins ACCA exam scores every single sitting. Here's the million-dollar question that trips everyone up. Where do your revaluation gains actually go? Never, ever put those increases straight to profit and loss. They absolutely must hit OCI first.
Want to dodge these traps and pass? Grab my paid FR notes right now and nail this exam.
All right, let's dive right in and outsmart those notoriously brutal ACCA exams together.
Still falling for sneaky examiner traps? Yeah, you're definitely bleeding easy marks right now.
I mean, the sheer volume of subjects, from AFM to law, it's literally panic-inducing.
But hey, don't panic. Examiners actually love testing the exact same traps year after year.
Emails are instant communication, meaning the postal rule does not apply, and they are only accepted upon actual receipt.
Seriously, download my paid law notes. They make these tricky exceptions second nature for exam day.
So your absolute best defense? The one-line trigger strategy for instant, reliable recall. By crushing paragraphs of complex rules into a single, punchy line, you guarantee immediate recall.
Also, stop ignoring the exhibits. As expert tutor Andrew Moore advises, the answers are literally hidden there. You gotta mind those facts to effortlessly score your professional skills and commercial acumen marks.
Finally, master the exam software, okay? Always type your discussion parts straight into the word processor.
So, are you practicing like you play? Stop cramming, start strategizing, and go crush it.
Welcome to This Explainer. We're diving into the absolute ultimate last-day survival guide to crush your ACCA exams. Feeling totally overwhelmed by those massive syllabuses? We're hacking your revision using Rohan's proven final day study methods. Your first weapon, the one-line trigger, it literally condenses those massive, terrifying frameworks into one single, actionable sentence. Like in APM, target costing just becomes price minus profit. In lifecycle costing, costs are locked at design. For PM, throughput is sales less material. In AFM, APV is base NPV plus tax shields minus issue costs. So why do this? Shrinking topics into single triggers guarantees crazy fast recall when you're under extreme exam pressure. All right, next up, dodging the examiner's traps. Rohan highlights exactly where students usually end up losing easy marks. In AFM, using WACC for base NPV is a total classic trap. Always use the ungeared cost of equity. For APM, please don't just list scorecard perspectives. You literally must link every measure to a strategic objective. In PM throughput accounting, never ever treat labor as a variable cost. Only material is truly variable here. Taking UK tax, protect your marks. Always deduct the £3,000 annual exemption before applying CGT rates. But look, knowing concepts isn't enough. You need Rohan's strict practice loop to crush those massive 50-mark questions. This loop is ruthless. Attempt your MCQs against a strict timer and then critically review every single mistake. When reviewing, basically log your answer, the correct one, your specific concept gap, and the exact fix required. Here's a pro tip. Screenshot your missed questions. Force yourself to review this digital failure log every morning and night. This daily repetition literally rewires your brain, so you'll automatically recognize those same tricky patterns during the real exam. Okay, now for the absolute most crucial piece of survival advice in this entire guide, the golden exam rule. Once your notes are done, just brave a full mock on the ACCA platform. Don't pause, then review deeply. Because, like Rohan says, you're going to learn way more from those painful mistakes than from passively rereading any notes. Quick reminders, always show your workings for method marks, link calculations to strategic advice, and attempt every single question. And remember, there is zero negative marking in ACCA exams. If you're completely stuck, seriously, just take a guess. Also, don't stress over perfect English. For written exams, marks are absolutely never deducted for minor grammar mistakes. So, you've got the triggers, the practice loop, and the golden rule. Now go apply them with absolute confidence. You have the ultimate survival guide now. So, are you going to let the examiner win or finally conquer ACCA? Let's expose a massive ACCA management accounting exam trap. Ready? Let's dive right in. Think about it. Does higher production automatically mean higher profits? Crazy enough, under absorption costing, it actually does. Picture your exam scenario. You're producing way more units than you actually sell. The results? Unsold units just sit there, and your closing inventory absolutely spikes. Why? Because those fixed production overheads get trapped inside the inventory instead of being expensed. But wait, here is the real catch.
Unlike absorption, marginal costing expenses those fixed overheads right away. Here's your golden exam rule. When inventory goes up, absorption profit is always higher. Master MA with my paid PDF notes. But tell me, what happens if inventory decreases?
Let's expose a massive ACCA management accounting exam trap. Ready? Let's dive right in.
Think about it. Does higher production automatically mean higher profits? Crazy enough, under absorption costing, it actually does. Picture your exam scenario. You're producing way more units than you actually sell. The results? Unsold units just sit there, and your closing inventory absolutely spikes. Why? Because those fixed production overheads get trapped inside the inventory instead of being expensed. But wait, here is the real catch. Unlike absorption, marginal costing expenses those fixed overheads right away. Here's your golden exam rule. When inventory goes up, absorption profit is always higher. Master MA with my paid PDF notes. But tell me, what happens if inventory decreases?
Hey there, welcome to this explainer on the ultimate ACCA last-minute survival guide. Feeling overwhelmed? Ready to finally crush these exams once and for all? Let's dive right in.
We're sprinting through the absolute highest yield concepts for AFM, APM, PM, and TX.
Starting with AFM, adjusted present value is crucial. It separates your operating NPV from financing side effects.
Follow this four-step flow from ungeared cost of equity to issue costs to conquer APV seamlessly.
Lock in this trigger. APV equals operating NPV plus the PV of those financing effects.
Jump into performance management. Avoid the dangerous sub-optimization risks of ROI by using residual income instead.
To master APM frameworks, you literally must link all 4 balanced scorecard perspectives directly to your strategy.
Always contrast traditional absorption with activity-based costing. ABC uses multiple drivers for complex products.
And here's a critical formula. Target cost simply equals selling price minus your desired profit margin.
Shifting gears to taxation. Mastering these UK non-savings income tax plans is absolutely non-negotiable.
Never forget the £12,570 personal allowance. It drops by £1 for every £2 over £100,000.
And £90,000. That's your magic number for compulsory VAT registration. Definitely commit that to memory. Beware of common exam traps, like using whack instead of key. They will needlessly destroy your marks. Here's the golden rule. Show all workings. Method marks always count, even with wrong totals. You've got the tools to conquer the practice platform. Apply them with absolute confidence, okay? So, which of these high-yield frameworks will you master first today? Go out there and crush it.
Okay, let's jump right into your ultimate ACCA survival explainer for these crucial final revision days. Feeling completely overwhelmed by all the material? Look, take a breath. We've totally got you covered here. We're boiling hundreds of pages down to high-yield triggers, common traps, and foolproof practice methods. So, first up, we're condensing those massively complex topics into single, super memorable sentences. Taking AFM? It's simple. APV is literally just your base operating NPV plus any financing side effects. For APM, the balanced scorecard perfectly splits into 4 parts: financial, customer, process, and learning perspectives. In performance management, always contrast the proportion of your inputs against your total actual yield output. And for UK tax, £12,570 is your absolute must-know personal allowance. Right, let's talk traps. These are the exact fatal mistakes examiners are actively trying to catch you on. In AFM, never use WACC for base NPV. Seriously, always use the ungeared cost of equity. For tax, don't forget to deduct that £3,000 CGT exempt amount first. It's easy marks. Okay, let's lock in your actual game plan. This practice methodology will absolutely maximize your final score. The secret sauce? Attempt the questions, turn on that timer, and deeply review every single mistake. Grab screenshots of wrong answers and use this exact review template to find and fix those conceptual gaps. Honestly, the best news is that ACCA has 0 negative marking, so definitely don't leave anything blank. Even if you're totally stuck, attempt the question and show your workings to grab those crucial method marks. Trust the process. You'll actually build way more mastery from your mistakes than just reading your notes.
You've got the playbook now, so which fatal exam trap are you going to permanently eliminate today?
Okay, here's a massive ACCA study hack for you.
Working full-time? Seriously, stop reading the entire textbook. You gotta prioritize high-frequency exam topics using targeted past paper practice.
Grab my revision guide. Ready to pass?
Let's dive into this explainer and conquer the insane time pressure of the AFM exam.
It's the ultimate frustration, being completely paralyzed by an impossible AFM scenario. It begs the question, why do incredibly smart, prepared candidates constantly fail this specific paper?
They fall into the perfectionist trap, sacrificing the whole paper just to nail one single calculation.
Never waste time trying to make your calculations perfect in AFM. If a calculation is too difficult, just make a number up and move on to save your time.
You will still get marks later using the own figure rule. Grab my paid AFM notes.
The harsh reality is the ticking stopwatch is your biggest enemy, not even the math itself.
Imagine the heartbreak of scoring a 48, just 2 points shy of passing, all because time expired.
So, to avoid this, practicing with strict timers and the ACCA software is absolutely critical.
Building that speed means zero distractions. Put your phone in another room during those practice mocks.
On exam day, skipping a whole question makes passing statistically improbable. You really got to manage those minutes.
Remember, there's absolutely zero negative marking in ACCA exams. Always attempt everything you possibly can.
Will you let the perfectionist trap fail you, or will you strategize your way to passing AFM?
Welcome to this explainer. Let's expose the ultimate MPV mistake that's literally killing your ACCA AFM exam score. Are you falling for a sneaky whack trap that wrecks your calculations from line 1? Let's find out. AFM pass rates sit at a brutal 45%, so making this mistake demands your immediate attention. We call it the coupon illusion. It's mistakenly treating a bond's coupon rate as the actual cost of debt. Never take that lazy coupon rate shortcut. The only correct way is calculating IRR based on market values. Examiners flag this all the time. It instantly costs you 2 marks before the NPV even starts. So how do we fix this? Let's pivot to the solution and save your whack waiting. Just follow these 3 steps. Find the market price, map the after-tax cash flows, and calculate the IRR. The coupon rate is what the bond pays, not what it costs. Always calculate the IRR of the after-tax cash flows instead to find your true cost of debt. Download my paid AFM notes. Listen, if an AFM calculation takes way too long, seriously, just guess and move on. You'll actually still get marks later using the own figure rule. So go grab my paid AFM notes right now. Listen up. Never waste time trying to make your calculations absolutely perfect in your AFM exam. If a calculation gets too crazy, literally just make up a number and move on. Save that time. Why? Because you'll still snag those follow-on marks later, thanks to the own figure rule. Want to crush it? Grab my paid AFM notes today. Are other perfectionist traps costing you a pass?
Prepping for ACCA AFM? Watch out, because there's a massive hidden study trap you need to avoid. Advanced financial management is intensely time-pressured. Managing that clock during practice, absolutely critical.
Because let's face it, almost nobody finishes an AFM exam with 10 minutes spare just to chill.
Especially after a long workday, cognitive fatigue hits hard, so you literally must practice strictly to time. But here's the dangerous illusion: using your everyday smartphone as your practice timer. Never use your phone as a timer when practicing AFM questions.
You will get distracted by notifications and completely ruin your time management.
Always use the ACCA software timer or a smart speaker.
Put your phone on silent and literally chuck it into a completely different room. What you actually need is pure, uninterrupted time practice, completely free from those annoying digital pings. This simple switch totally builds a highly effective, bulletproof daily study habit.
Maximize that free ACCA software so you're fully comfortable with the actual exam interface. Banish that phone today, reclaim your focus, and grab my paid AFM notes.
Welcome to the Explainer. Today, we're doing something totally different but incredibly practical. We are diving into a cinematic, dual iterative lesson on corporate governance, and we're using the spectacular, dramatic collapse of the energy giant Enron to actually practice and perfect our professional English. Basically, we're going to blend an epic corporate thriller with a linguistic framework that's designed to make you sound like a highly seasoned finance executive.
Now, what's really unique about this explainer is our method. We aren't just recounting the facts of the fraud. We're going to use a technique called shadowing to help you build the prosody and automaticity of financial authority. Shadowing is essentially acting as a vocal echo. By repeating exactly what you hear right after you hear it, you bypass your brain's natural tendency to translate. Instead, you directly absorb the rhythm, the intonation, and the stress of native authoritative speech.
So here is how this methodology breaks down into 4 phases. We start with silent observation. That's where you just listen to the stress patterns. Then we move to subtitled shadowing, where you read and speak simultaneously. Next up is non-caption shadowing, relying purely on auditory clues. And finally, content synthesis, which lets you explain the concepts entirely in your own words. By the end of this explainer, you'll have physically trained your voice to carry the exact emotional weight and phrasing of top-tier corporate analysis.
Our agenda for today maps out this journey perfectly, starting with the power of shadowing, moving into Iteration A's human drama, the agency problem, Iteration B's forensic analysis, board oversight, and wrapping up with a final synthesis.
Let's jump right into Iteration A, the human drama. Enron's top executives, particularly Chairman Ken Lay and CEO Jeff Skilling, operated with notorious hubris. They genuinely believed they were simply the smartest guys in the room, right? They projected this massive, bulletproof illusion of corporate invincibility, all while hiding a deep structural rot. To really capture the severity of this deception, consider this statement from the Department of Justice following their convictions. Pay close attention to the emotional weight, the sharp consonants, and the deliberate pacing of the words. It's not just about what is being said. It's about the definitive legal authority with which it's spoken.
All right, now it's your turn. I'm going to say the phrase, and in the pause that follows, I want you to repeat it out loud exactly as I did, to train your voice and your confidence. Ready? Protracted, deliberate, and dishonest.
So the crucial point underlying all of this executive hubris is what the Association of Chartered Certified Accountants, the ACCA, defines as the agency problem. This is a fundamental concept in business. It happens when ownership, meaning the shareholders or principals, is completely separated from control, meaning the managers. And when this disconnect happens, managers can start acting entirely in their own self-interest, chasing short-term bonuses or empire building at the complete expense of long-term shareholder value.
Let's practice the core logic of this governance failure. This is a phrase you are going to use constantly when diagnosing corporate dysfunction. Listen closely to the rhythm, and then echo it out loud in the pause. Managers prioritize self-interest over shareholder returns. Perfect. Building that automaticity means you literally won't even hesitate when explaining complex conflicts of interest.
Moving on to iteration B, forensic analysis.
Let's shift from the boardrooms down to the balance sheets. Enron's chief financial officer, Andy Fasto, utilized thousands of incredibly complex corporate structures called special purpose entities, or SPEs, to systematically mask volatile failing assets. But crucially, these were not legitimate risk transfers. Fasto set up secret side agreements that ensured these entities assumed no true economic downside. This effectively made the hedges entirely fraudulent from the very beginning.
And the sheer scale of this fraud, it is just staggering. To keep this illusion of cash flow alive, Enron systematically used finely tuned prepay transactions. Whenever they approached the end of a reporting period, they'd project their shortfall and just use these prepays to plug the reporting gaps. Between 1997 and 2001, Enron pulled in over $5 billion in funds through this highly deceptive maneuvering.
The infamous Raptor hedges represent the absolute peak of this madness. Think about this. Enron was using these SPEs to hedge the value of its own highly volatile tech investments. But here is the fatal foundational flaw. They were essentially entering into hedging contracts with entities that were backed almost entirely by Enron's own highly leveraged stock. They were literally doing business with themselves. It created a massive house of cards that was guaranteed to instantly collapse if Enron's stock price ever dropped.
Listen closely to this forensic conclusion regarding those fraudulent structures. Focus on the highly technical rhythm here and the authoritative tone used to describe the exact accounting remedy that was needed.
Take a deep breath and let's shadow this advanced vocabulary phrase. Speak it out loud in the pause with conviction. Unwound the structure and recognize losses.
Great job. That phrase perfectly encapsulates the painful reality that Enron's management was so desperately trying to avoid.
Which brings us to governance and board oversight.
All of this forensic analysis begs a massive question. Where were the adults in the room? How did these convoluted technical tricks and blatant self-dealings completely bypass the leaders at the very top? Well, by definition, according to the ACCA framework, corporate governance is fundamentally not about running the day-to-day operations. Instead, it's the vital, overarching system by which a company is directed, controlled, and kept fully accountable to its stakeholders. Basically, it's the guardrails on the highway.
And the Enron board catastrophically failed to maintain those guardrails. They failed to monitor management. The board is there to provide direction and oversight, to ask the really hard questions, right? Yet they explicitly allowed their own CFO, Andy Fasto, to serve as the general partner of the LJM's special purpose entities. They allowed him to sit on both sides of the negotiating table. It was a complete failure to manage a glaring conflict of interest that ultimately destroyed the entire company.
But it wasn't just the board. The vital external check on the company failed too. Their auditor, Arthur Andersen, had a severe conflict of interest, driven by millions and millions in lucrative consulting fees. The supposed watchdogs literally helped design the LJM and Raptor structures. This created a complete disconnect between Enron's financial reporting and its actual economic reality. They improperly allowed Enron to offset losses and completely failed to record significant impairment charges.
Okay, time for our final shadowing drill. I'm going to say the full sentence, and then we will repeat just the key phrase to really cement this governance failure into your professional vocabulary. The systemic auditor conflict of interest blinded the board. Now shadow the phrase. Auditor conflict of interest blinded the board. Fantastic. You are now wielding the language of high-level financial analysis.
As we synthesize these technical terms and profound governance lessons today, I want to leave you with a final thought to ponder. We've seen how easily human hubris can manipulate complex accounting when oversight entirely fails. Based on what we've unpacked, the agency problems, the off-balance sheet masking, and these massive conflicts of interest, are modern corporate structures truly immune to another Enron? Or are we just waiting for the next set of smartest guys in the room? Keep practicing that shadowing, keep asking the hard questions, and we will see you on the next Explainer.
Welcome to this Explainer. Today, we're putting on our financial detective hats to decode exactly how massive corporate failures actually happen. We're not just staring at the aftermath, right? We're doing a full-on autopsy of one of the most infamous financial disasters ever, the Enron scandal. By digging into the exact mechanics, from the rigged math to the shady legal paperwork, we're going to understand how billion-dollar empires completely crumble. And as you'll see, we're going to connect these historical mechanics to modern disasters like WeWork, because, spoiler alert, history definitely repeats itself.
Okay, let's start with this visceral warning from a real insider. These words came directly from an anonymous memo sent by Enron accountant Sharon Watkins to her CEO way back in the late summer of 2001. She was a seasoned professional who took a hard look at the balance sheet and realized, hey, this multi-billion-dollar valuation, it is literally standing on a house of cards. She saw the implosion coming before anyone else even had a clue.
And that leaves us with a pretty profound question. I mean, Enron's executives were celebrated as absolute, untouchable visionaries. So how exactly do fundamental financial mechanics get manipulated to fuel such a catastrophic collapse? It's not just about simple greed. It's about weaponizing the accounting itself. And that's a playbook that certainly didn't end with Enron, as we've seen with some spectacularly messy modern collapses.
Which brings us to Section 1, the deadly agency problem.
So the real root cause of the Enron disaster is something called the agency problem. Basically, when corporate governance totally breaks down, you get executives who start prioritizing their own empire building and massive compensation packages over the actual health of the company. We saw this exact dynamic with Ken Lay and Jeff Skilling at Enron, and honestly, we saw decades later with Adam Neumann at WeWork. You got executives prioritizing self-dealing and the illusion of success over the actual viability of the business. They weren't managing risk for the shareholders, they were just managing the narrative to get their own payouts.
All right, moving to Section 2, valuing a company correctly. Because before we can see how they broke the machine, we kind of need to understand how the valuation engine of a healthy company is supposed to work.
And it all starts right here with WACC. That's the weighted average cost of capital. WACC is basically how a company calculates its true cost of funding. Like, are they borrowing money? Are they issuing stock? WACC takes all of that and blends it together into a single discount rate. And here's the kicker. Any error here completely wrecks the net present value, or NPV, of their investments. If you get your WACC wrong, you are literally mispricing the entire future of your company.
Now, the most common WACC errors aren't just academic theory. They are exactly where real companies go completely off the rails. Think about using book values instead of actual market values, or simply forgetting to calculate the tax shield on debt. When companies, whether intentionally or just accidentally, bungle these inputs, their valuation becomes entirely disconnected from reality. They might be patting themselves in the back thinking they're generating value, when in fact, they are actively destroying it.
But remember, behind all these numbers and WACC calculations are real people, real accountants and financial planning and analysis professionals. They sit at their desks absolutely agonizing over subjective fair value reporting inputs. Whether we're talking about Enron in 2001 or WeWork trying to invent totally fake metrics like community-adjusted EBITDA in 2019, professionals trapped in toxic corporate cultures face immense pressure from management. They're pushed to make the numbers hit a specific target rather than, actually reflecting reality.
Let's jump to Section 3, hiding the bad news. Because what actually happens when those real numbers start to look bad?
Well, this is where Enron got incredibly creative. They used deconsolidated entities, which they coolly named the Raptors, to hide bad assets entirely off the balance sheet, using secret oral side agreements so they wouldn't have to show massive losses. Now, contrast that Wild West approach with modern accounting standards today. Think about IFRS 16. Today, the rules force companies to bring their liabilities completely out of the shadows. They require transparent right-of-use assets and lease liabilities to be explicitly recognized for almost all long-term leases. And actually, this exact rule change is what helped expose WeWork. WeWork was on the hook for nearly $50 billion in long-term lease obligations. Under modern accounting rules, it was impossible to hide that crushing debt from investors. Enron, on the other hand, existed in a regulatory blind spot that they ruthlessly exploited.
Which leads us to Section 4, when gatekeepers fail. To pull off a fraud this massive, the internal gatekeepers have to be involved, and they were. The Securities and Exchange Commission ultimately charged Enron's own in-house counsel, including the General Counsel of Global Finance and the Associate General Counsel, with participating in a fraudulent scheme. Think about that. To hide billions in debt, the very people hired to ensure the company was acting legally were the exact ones getting indicted.
These executives didn't just make innocent math errors in their WACC calculations. No, the SEC charged them with systematically omitting material disclosures from public filings and actively aiding in anti-fraud violations. They did it all just to keep the illusion alive.
What makes this so staggering is the immense position of trust they held. The very legal experts responsible for Enron's proxy statements and 10K filings, the exact documents that everyday investors rely on as the absolute truth, were actively closing fraudulent related party transactions.
In fact, the SEC documents reveal they recklessly disregarded accounting rules just to honor a secret oral agreement. This agreement guaranteed that a related partnership run by Enron's own CFO, Andrew Fastow, wouldn't lose any money. Even when the investment completely tanked, Enron paid them a profit anyway. They completely destroyed shareholder transparency just to protect their own internal cartel.
Okay, Section 5, the rapid unraveling.
Let's look at how fast this all comes down. On August 14, 2001, CEO Jeff Skilling unexpectedly resigns, claiming personal reasons. But on that exact same day, our whistleblower, Sharon Watkins, who is terrified by the hidden derivatives tying the firm together, decides she needs to find a new job immediately. By late summer, her anonymous memos leak. And much like WeWork's catastrophic record-speed jump from an attempted IPO to near bankruptcy decades later, the collapse from Titan to laughingstock happens in months, not decades. A titan of American industry literally vanishes overnight, plunging into bankruptcy and triggering years of grueling litigation.
Finally, Section 6, Essential Lessons for Investors. We really can't just look at this as ancient history. We have to treat it as a warning.
Because whether it's the dot-com bubble, Enron's hidden off-balance sheet entities, the 2008 mortgage crisis, or WeWork's spectacular IPO failure, the core lesson is always exactly the same. You absolutely must analyze the unvarnished fundamentals. You have to look at the underlying business model. Is it generating real cash or just accounting profit? You need to conduct your own independent research and entirely ignore the herd mentality. Because when the herd is aggressively chasing a stock based on complex leverage they don't even understand, a cliff is usually right around the corner.
Ultimately, evaluating all these mechanics falls on human shoulders. The math doesn't do itself, right? It relies on analysts, accountants, and everyday investors seeking the truth. Which leaves us with one final, sobering question for your own career and your own investments. When your analysis influences a major business decision, will you get it right, or will you just look the other way? Thank you so much for joining me for this explainer, and I'll catch you next time.
Listen, fixing broken products, it absolutely destroys your profits. Let's dive into the cost of quality.
So, to protect those margins, you've got to track your absolute cost of quality across the whole shebang.
Now, this isn't just about repairs. It's the total cost of preventing, finding, and fixing defective products.
It really boils down to two main buckets, right? Failures before shipment versus failures after shipment.
Internal failures? Yeah, those mean massive scrap costs, tedious rework, and some seriously devastating machine downtime.
But external failures are way worse. We're talking expensive customer lawsuits and totally wrecked brand reputations.
But wait, here's the catch, and it's something most businesses completely miss. Prevention is literally cheaper than fixing failures. Seriously, investing in prevention saves you an absolute fortune. To stop bleeding cash, you absolutely must invest heavy in the proactive stages, prevention and appraisal.
Like prevention means thoroughly training staff and reviewing designs before production even kicks off. Catch it early.
And appraisal? That's inspecting and testing during production to catch slips before your customer ever sees them. Managing these 4 categories slashes costs like crazy. You've got to be constantly tracking your defect rates.
Want to totally crush your APM exams? You can master all this using my highly focused paid notes.
So, think about it. Are you actually investing in prevention or just paying endlessly for failures? Did you know the global pass rate for the ACCA APM exam often plummets to just 34%?
Let's dive right into ACCA APM, the consultant's playbook. We're going to fix that fail rate today.
Why do so many fail? Well, candidates wrongly treat this advanced exam just like a basic skills paper.
PM is about calculating variances, but APM? It demands you evaluate if those targets were actually realistic.
Managers shouldn't take the hit for wild market shifts. Nailing this concept gives you a massive strategic edge.
Always ground your analyses in real-world constraints. Think like a senior consultant, not a textbook.
The examiner literally hates generic lists. You need punchy, scenario-specific answers to grab those passing marks.
Here's the real challenge. You've got to dig deep and explain exactly why the whole performance system collapsed. Terrible metrics breed bad habits. Employees might game the system or ditch long-term growth for quick bonus cash. So how do we actually fix this? We use structured frameworks to lock employee behavior onto company strategy.
Take the balanced scorecard. It brilliantly balances financial wins with the actual operational drivers of future success.
See the flow? Training staff improves processes, which thrills your customers. And boom, that drives massive financial profits.
Exam technique is make or break. Ignore the specific verb and just write generic fluff, you will fail. Here's the golden rule. State your assumptions, show your math, and always tie calculations to strategic advice.
Do mocks under brutal time pressure. Just passively reading model answers definitely won't build your exam skills.
APM is not a technical math paper. Examiners reward commercial thinking and explaining exactly why a performance system failed.
Get my paid APM notes. So ask yourself, do your answers sound like a student or a consultant?
Hey everyone, and welcome to this explainer. Today, we are diving into the fascinating strategies and frameworks that are literally defining advanced performance management in 2026. Think of this as your strategic briefing. As we go through these concepts, you'll see how shifting from a traditional, purely number-crunching mindset to more of a consultant's perspective can absolutely change how we evaluate a business. It's going to be a great one, so let's get right into it. Here is our agenda for this explainer. Section 1 covers behaviors and dysfunctional metrics. Section 2 is moving beyond traditional budgets. Section 3 focuses on big data and customer profits. Section 4 handles controlling quality and projects. Section 5 looks at ESG, the modern strategy. And we'll wrap up with Section 6, thinking like a consultant. Okay, Section 1, behaviors and dysfunctional metrics. To really understand performance management, we have to remember one fundamental truth. Right behind every single financial number is human behavior. Poorly designed metrics inevitably lead to people just gaming the system. We call this dysfunctional behavior. It's when actions are taken purely to manipulate performance measures or hit specific targets, completely ignoring or even actively damaging the organization's actual long-term strategic goals. And you've probably seen this play out in the real world. By the way, watch out for these because they are classic exam traps. First up is gaming. This is manipulating the timing of things, like pulling sales forward into the current quarter or pushing off necessary expenses just to hit a bonus target. Then there's smoothing, where managers tweak earnings to artificially avoid volatility. Then we have short-termism, which is honestly incredibly destructive. It's when a manager slashes crucial long-term investments like R&D or equipment maintenance, just to give this year's profit a quick artificial bump. And finally, budgetary slack. That's intentionally overestimating your costs or underestimating your revenues to make the budget a total breeze to achieve. So if the numbers look amazing but the underlying strategy is completely failing, well, one of these is usually your culprit. Now, the type of budgeting an organization uses actually directly impacts these behaviors. Participative or bottom-up budgeting is fantastic for increasing ownership, commitment, and morale, but as you might guess, it creates the perfect breeding ground for that budgetary slack we just talked about. On the flip side, imposed or top-down budgeting is really quick and mostly avoids that slack. The trade-off, it can be incredibly demotivating for the team and often sets completely unrealistic targets. So there are pros and cons to every system. Moving on to Section 2, moving beyond traditional budgets. So how are modern businesses actually solving these behavioral issues? Well, let me pose this question directly to you. Are annual fixed budgets dead? Think about it. In today's highly volatile, super dynamic business environment, tying a company to a rigid 12-month contract based on outdated assumptions is kind of becoming a massive liability, right? Traditional budgets rely heavily on fixed annual targets and basic variance analysis, which honestly just encourages rigid silos and that gaming behavior. Enter a concept called beyond budgeting.
This is a real game changer. It abandons the fixed annual contract entirely. Instead, you're looking at rolling forecasts, adaptive KPIs, and allocating resources based on continuous actual need. It makes businesses vastly more adaptive and strips away a lot of that intense political behavior that usually plagues traditional budgeting cycles. Section 3. Big Data and Customer Profits. Okay, you simply cannot talk about modern performance management without bringing up the 4 V's of big data. We have volume, just mind-boggling amounts of information; velocity, meaning it's generated in real time; variety, it comes in structured formats like databases and unstructured formats like text or video. But here is the absolute crucial point, the 4th V, veracity. This is the quality and accuracy of your data. Look, big data enables incredible things like real-time dashboards and predictive analytics, but if your veracity is poor, you are literally just making bad decisions faster. Let's actually look at how data changes our view of profit with a customer profitability analysis. Take customer B here, for example. At first glance, a revenue of £80,000 with a cost of goods sold of £50,000 looks like a very healthy £30,000 gross profit. Sounds great, right? But wait. When we use activity-based principles to allocate the total service costs, things like order processing, complex delivery, and intense customer support, which total £33,000, the whole reality shifts. This supposedly high-revenue customer actually generates a negative profit of minus £3,000. This is a classic APM trap to watch out for. Remember, not all revenue is good revenue. Next up, Section 4, Controlling Quality and Projects. Shifting our focus over to operations, quality isn't just some corporate buzzword. It has a very specific, measurable cost structure. The cost of quality moves through 4 distinct stages. First up is prevention. This is investing early in training and process design. Second is appraisal, inspecting and testing the product. Third is internal failure, the cost of rework and scrap before the product ever even leaves the factory. And finally, the absolute most dangerous stage, external failure. We're talking warranty claims, lawsuits, and devastating loss of reputation. The golden rule here? Investing early in step 1, prevention, is always cheaper than paying for an external failure down the line. Now, when you're managing complex projects, Earned Value Management, or EVM, is a brilliant tool to have in your playbook. I'd highly recommend grabbing a screenshot of this slide. EVM takes 3 simple metrics: planned value, earned value, and actual cost, and ties them together into one objective framework. By calculating cost variance, which is just earned value minus actual cost, you instantly know if you are under or over budget. Schedule variance, earned value minus planned value, tells you exactly if you're ahead or behind schedule. It completely removes all the guesswork from your project reporting. Section 5, ESG, the modern strategy. Look, sustainability has definitively moved from a niche feel-good concern straight into a core boardroom strategy. Data sourced from LSEG's 2026 Sustainable Investment Trends Report shows the estimated operational expenditure of a 100-megawatt data center. Notice that massive blue bar? Yeah, that is electricity. Artificial intelligence and tech expansion requires staggering amounts of power. Because of this, the E in ESG, environmental impact and energy efficiency, is a massive financial and strategic reality right now. It's really not just a PR exercise anymore. It is about fundamentally managing operational costs and mitigating the very real physical and regulatory risks of climate change. And because ESG is now core strategy, we need hard performance measures to track it. For environmental, we track Scope 1, 2, and 3 carbon emissions, water use, and energy efficiency. Social metrics look at things like employee turnover, health and safety records, and community impact. Governance covers board diversity, ethics violations, and whistleblower systems. The key takeaway here for any performance manager is a concept called integrated thinking. You absolutely must be able to link these non-financial ESG targets directly back to long-term financial value creation and risk mitigation. Finally, Section 6, thinking like a consultant. Okay, we have covered a lot of ground today, so let's bring all these concepts together and focus on how to actually execute this knowledge out in the real world, and critically in the exam room. If you are sitting the ACCA APM exam, you need to understand exactly how the examiner thinks. Number 1, application beats memory. Seriously, do not just rewrite textbook definitions. You must apply the concept to the specific scenario they give you. Number 2, structure signals competence. Use headers, use paragraph breaks, make it flow logically. Number 3, interpret the verb carefully. If they tell you to evaluate, you must provide a conclusion. If they say calculate, you better show your workings. And finally, the most important rule of all, link it back to strategy.
Never ever present a metric or a variance without explaining exactly what it means for the organization's overarching strategic goals. Remember, your job isn't just to crunch the numbers, it's to tell the board why the numbers actually matter.
I want to leave you with an empowering little mantra from our source material today. Design measures that matter, align with strategy, manage behavior, pass APM. Ultimately, advanced performance management is fundamentally about designing systems that drive strategic success without triggering those dysfunctional habits we talked about earlier.
So, I want you to think about your own workplace, or even the case studies you're reading. What broken metric is secretly driving bad behavior right now? I challenge you to apply this consultant mindset today to find out. Thanks so much for joining me for this explainer. Keep analyzing, keep questioning, and I'll catch you in the next one.
Listen up. Leaving a corporate group can actually trigger a massive, unexpected tax bill. It's called the hidden degrouping charge, and it's a brutal trap that catches so many students out. The baseline rule: asset transfers inside a 75% corporate group are completely tax-free. We call this a no-gain, no-loss scenario. Sounds totally safe, right? Well, here's the catch. There's a dangerous trap waiting just out of sight. 6 years. If that receiving company leaves the group within 6 years, your safety net vanishes. Boom, that deferred tax gain instantly crystallizes, and you suddenly owe all that tax. Worse, the charge is calculated at the asset's original market value from the time of transfer. Don't let this ruin your client. Grab my paid ATX notes right now to pass. Hey, welcome to this explainer. Let's dive right into advanced taxation and a massive inheritance tax relief. £500,000? That's the crazy amount of your estate you can totally protect from the taxman. It starts with the standard nil rate band, anchoring your tax-free baseline at a cool $325,000. But wait, slap the residence nil rate band on top of that for another $175,000. So combining those two, boom, your total tax-free threshold skyrockets to a whopping £500,000. But catch this, it's only for main residences, it transfers between spouses, and tapers for super large estates. Watch out for that taper, guys. You lose 1 pound of relief for every 2 over 2 million. Now for a classic examiner trap. Who actually qualifies to inherit this sweet, sweet allowance? You've got to know the difference. Direct descendants totally qualify, but other family members, no way, they get nothing. The residence nil rate band strictly applies only to direct descendants, like children, never to just any family member. Grab my paid ATX notes. So, will you remember to protect that $500,000 and dodge those tax traps on exam day?